Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Kyle. Kyle, go ahead and tell the people a little bit about yourself.
Hi, Troy. Very nice to be here. Thank you so much for the invitation. My name is Kyle. I am a Brazilian. I live in Italy currently. I moved because of my job. I'm a mechanical engineer. And I'm passionate about dividend growth investing companies.
Yeah, that's super cool, man. So where were you born?
So I was born in São Paulo, in Brazil. 7 years ago, I moved to Italy. My company sent me here. My wife came with me. We got married. She came with me. And by the way, she's the one that introduced me to the investing world.
Oh, that's super cool. So was she investing before? Or did she just like think that this would be something that you were interested in, or how was that?
Yeah, we were on vacations in Brazil. I was already living here, and she started to introduce me to her portfolio, which at the time was mainly composed by instruments that are very similar to bonds in Brazil. And I got passionate about the idea of earning money just because I'm saving money.
Yeah.
And then I started to study more and more. And last year, I got introduced to the concept of dividend growth investing. And that's when my world changed.
Oh, I'm really excited for this interview. That's going to be cool. So, okay. Well, so speaking of that, the first question is going to be, when did you begin investing specifically? And then what got you into the dividend side of things? You said the idea of like making money passively just by, saving money, or in this case, investing money. So talk a little bit more about that.
Yes. So I started not so long ago, unfortunately. I started with those instruments that I mentioned before that are very similar to bonds in Brazil. And then slowly I got introduced to the concept of passive income, getting paid just because I'm saving money or because I'm buying financial instruments. And I started in Brazil buying companies that pay dividends. But in Brazil, you don't have companies that pay increasing dividends every year. And when I joined the Facebook group that you are in also. Mm-hmm. I started to study. I started to read lots of books. I brought some here if you want to discuss about them. And then when I discovered that there are companies that pay increasing dividends every single year, and that I know that I will receive more dividends next year, even if I don't reinvest the dividends that I receive, even if I don't infuse more capital, I got completely passionate about the concept and I started to study a lot. And this started less than 1 year ago. So I still can't perceive the snowball effect that everyone talks about because I have just started, but I know it's real, and that's what I'm chasing.
Do you just like tips? So you've been investing for less than 12 months, right? Like in the dividend growth stocks?
Dividend growth investing, yes.
Okay. So do you have a way to track your, like this is actually like tips for you. Do you have ways like Excel or whatever to track your dividends?
Yes.
Okay. I think that's very important because what you're going to notice is when you first start is like the dollar amounts that you're going to be getting from, Coca-Cola or whoever is going to be very small, especially if you're into like super high dividend growth companies, which is what I'm into. The yields are typically very low. So you don't get paid, get paid nothing. Like Apple and stuff, like they don't pay out big yields. But what I want you to do, if you're not already doing this, is really pay attention to like, okay, last January to this January, and focus on the year-over-year growth of that amount. Don't worry about the amount. Like it might only be, okay, $4 last January, now it's $12 this year, but that's a 300% growth. And like, that's what you can focus on. And I always tell people that focus on the percentages when the numbers are small. And then when the percentages start getting small, the numbers are going to get big.
I agree 100%. I control a few metrics in order to understand how well I'm doing with my portfolio. One of them is the dividend growth year over year. Like you said, January last year compared to January this year. This number is still not so calibrated because when I started, like most of us, I have put some yield traps in my
Yep.
portfolio.
Yep.
So I sold them. And so now it feels like my dividend is going down, but only because I got rid of yield traps and now I'm focusing on dividend growth and not so much in dividend yield.
Mm-hmm.
One metric that for me it's fundamental is dividend safety. I
Yep.
want to make sure that the companies I have, they're gonna continue to increase their dividends every single year. So to control that, I do some due diligence myself. I check the earnings call. I try to read balance sheets. I'm just starting to understand how this works. But also, I'm a big fan of Simply Safe Dividends, and they give you a dividend safety score for each company. So from 0 to 99, and then I try to focus on companies that have 80 or more dividend safety score by Simply Safe Dividends. I like to control that. My target, my own target, is to have a 12% increase in dividends every year without counting the effect of new capital
Mm-hmm.
infusions.
Yeah.
I want to have 12% just by the company, just by the increase of the companies plus reinvesting of dividends. That's my target. And middle this year, I'm gonna check if I got it or not.
Yeah. So when did you get your first dividend? Do you know?
My first dividend was paid in July last year, but still, again, I still had some yield traps in my portfolio, like AT&T.
Yep.
I had ZIM, the
Yep.
Chinese logistics company, with a huge,
Yeah.
dividend yield. I got rid of them. Then my second mistake was focusing more on dividend yield than dividend growth.
Yep.
And now I'm passing to dividend growth and not so much dividend yield.
Yeah. Yeah. I mean, that's really important. Like so that's actually the next question is like, what's the biggest dividend related mistake you've made? And more importantly than the mistake is what lesson did you learn from making that mistake?
Yeah, for sure. My biggest mistakes were focusing on yield. Some mistakes that I committed also before was just watching some YouTube channels talking some nice things about a company and then buying that company
Mm-hmm.
without understanding why.
Yep.
Um, One thing that it's a bit controversial, but for me it's very important. I like to do some kind of valuation to the companies that I want to earn, that
Mm-hmm.
I want to buy.
Mm-hmm.
And for me, it's very important to buy them with a certain margin of safety.
Yeah.
Before, I didn't pay much attention to price, so I just bought what I wanted. Now, I discovered that for me, I sleep well at night when I buy the assets that I have with a good margin of safety.
Yeah.
So I know there are lots of for lots of people, price don't matter, and I can understand that. What is your opinion on that?
Yeah. So I mean, I made a video talking like literally titled that same thing, stock price doesn't matter. And I was hoping it would go a little bit more viral just because of how controversial it is. But I'm on the side where I believe that, but I only believe it in situations where like, how old are you? Did you say how old you were?
I'm 32.
Okay, yeah. So you're relatively young. I'm young too. Like I just turned 29. So like we have such a long time that and to me like the argument of price doesn't matter is really based on several different factors. Like if somebody just says price doesn't matter, like that's just genuinely not true. But if you list the reasons why, so the two reasons I outlined in the video were fractional shares and dollar cost averaging, because you can do both of those things. You can buy little pieces of companies and you can do it however often you want as the price goes up and down, which gives you the average price over time. The thing that people need to consider with that, in my opinion, is how long you have until you need the money. Like if you're 65, I think price matters a lot more because you don't want to buy, say you want to buy Nvidia right now, but Nvidia, corrects or whatever back down to 500. You're kind of screwed. Like you're not going to buy Nvidia because it's a dividend growth stock. Like that stock doesn't grow to dividend at all. But and if you have enough Nvidia to live off of the dividends, you basically own the company at that point. I pay 4 cents per share. But anyway, so like that matters a lot. And then also like understanding that you like it's all about, again, risk. It's all about the timeline that you have left. and all kinds of stuff like that. So like and the last thing, and I said this in a couple other interviews, the last thing is the optimism that the stock that you really like, the only thing that you don't like is the price, which isn't a fundamental of the company, and the opportunity that you would miss on not buying that because it didn't hit some magical price that you picked out of your head. And like whatever price you identify versus what I identify, which is what the analyst identifies or whatever, they're all so vastly different. And I know from that dividend growth investing Facebook group that we're part of, there were several stories. I tell this in like every interview. Several stories are where people never bought Apple because they wanted Apple at 88.11 and it got down to 88.15. And they were like, no, I'm waiting for 88.11. So instead of biting the bullet and getting it because of some arbitrary number that they made up, they missed out on hundreds or thousands of % gain because they wanted it to get a certain price. And I'm like, oh, like that to me isn't worth the, okay, yeah, I could have got a little bit better cost basis, but that's not really worth it.
You mentioned a few words that I like a lot, and I wanted to expand this a little bit: dollar cost averaging, risk, and price. I think it's like I mentioned. I think it's a personal thing. For me, it works fine. I need to wait for something to grab something with a margin of safety. Otherwise, I wouldn't sleep at night.
Yeah.
I think instruments like dollar cost averaging is amazing, especially for ETFs.
Yep.
Because ETFs, how do you calculate what is the fair value of an ETF?
Yeah.
There are hundreds of companies inside of it. It's very difficult. But with dollar cost averaging, I like to apply dollar cost averaging in instruments like this. I recently learned in the last book that I read, it's called Value Averaging. I learned that dollar cost averaging is not commonly applied in the right way. So what is DCA? DCA is about buying the same with the same amount of money, buying the same stock with a fixed frequency, right? So every first of each month, you're gonna buy $500 of Apple. If Apple decreases in value, you buy more shares. If Apple increases its price, you buy less shares. And like you mentioned, you tend to have an average price that is below the current market price if we're talking about an asset that just increases over time, like Apple. Problem with DCA over the long term is that if you are applying the fixed amount of capital every time, inflation is gonna corrode that amount of capital. So if you're applying $500 now, in 20 years, when you're gonna apply $500, you're gonna be buying less stakes of Apple because those $500 value less. So it's very important to correct dollar cost averaging with the inflation, and not so many people talk about it. And what these books go even beyond. It says that correcting to inflation is not enough. You need to correct to the market growth rate, which is bigger, which is higher than inflation. So if you are able to correct frequently your dollar cost amount with the same growth of the market, then you have the real value of buying more shares when they went down, and buying less when they went up.
Yeah. Yeah, I do like that. Like so I dollar cost average every day. I don't know if you heard me say that before. Like it is a lot, but I also like seeing like buying little bits of a stock and then like seeing my projected annual dividend income, my patty, just go up by a couple cents every day. Like that's cool to me. And it helps me not chase the yield like you were talking about. Cause like I think everybody that does dividend investing went through that thing. Some people are still in that thing. And if you don't think you're in that thing, then you're in that thing. Like that's what you're doing is chasing yield. But it's just one of those things where, what I do is I don't know, I think right now this year it's going to be, $833.34 per month to go in this taxable account. And how I figured that out is we have $2,000 per month that we're investing, but we have two Roths that we're maxing out, her Roth and my Roth. So we're dividing the 7,000 by 12. That's how much we're putting in per month into each of our Roths, and whatever's left, which is $833.34, is what we're investing. So what I do is I have 11 stocks. Only 9 of them are active. Like I started a new thing this year where I have an active and dormant strategy. And this is one thing that you might be able to take away is like if you identify a stock that you really liked for XYZ reasons, one, you should write down why you buy stocks. So like whatever stock you're buying, just say, hey, I'm buying XYZ stock because of this, 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 this. If any of these things change, I can reconsider. But if just because the price goes down, that's not a reason. Because the price is not a thing that tells you whether the company is good or not good. It's all the things that relate to the price going up or down. So definitely recommend doing that. But what I'm doing with this active and dormant strategy is I only have 3 metrics that I judge my stocks by. Because like I'm not really, I've tried to look at balance sheets. I've tried to look at all the fundamentals and stuff like that. It just doesn't compute in my head. So what I tried to do is tried to pull back and say, okay, stocks with good balance sheets and stocks with good fundamentals, what do they always have in common? Well, they're able to raise their dividend year over year constantly. Generally, they're able to do that by bigger amounts. So therefore the dividend growth rate is higher. And they typically do a very good job of keeping up with and outperforming the S&P 500. Those are my 3 metrics. So like it's all one of those things where like, okay, how simple can you make complicated metrics to make sure that you can follow them and they're understandable? Because like you can make some complicated metric, but then if you don't understand your own metrics, like you're not going to be able to follow them, and then they're useless. So, but yeah, so my active and dormant strategy is I had 2 stocks, which are ExxonMobil and Starbucks, that fell off of my most important metric, which is outperforming the S&P 500. So over the last 10 years, they haven't. Those are the only 2 of my 11. So I'm not selling them because there's still other things about those stocks that I still like. I'm just not adding, I'm going to let them drip, but I'm not adding any of my own money because a lot of times, so in the interview I did with Dave Maloney months ago, he talked about his biggest mistake in dividends is selling X, Y, Z in stock. Like he identified that as a company he liked, therefore he bought it. But then something random happened that wasn't really changing the fact that he did or didn't like that company. And then he sold it and then it ended up doing well like he thought it would because he bought it for a reason. So I just want to keep those companies. I like them both. I think that they're both going to do well over the long period. And next year or whenever I want to, I might reevaluate halfway through the year or something. I don't know. It's my first year doing it, but I'll reevaluate. And if I look at the 10-year chart and now they're outperforming, I can start adding to them again and keeping those positions balanced. But
I like your mindset. I like the metrics you have. I'm very similar. One thing that I look also for the companies that are, and that's the beauty of dividend growth investing. If we focus on this strategy, we are already removing 1,000 of bad companies from our scope. It's very difficult to be a bad company and increase your dividend every single year.
Yeah.
Of course, there are bad companies that do that.
Yeah, do it by big amounts and do it for years and years and years and decades in a row. Like that's the hard part.
And that's one of the metrics that I like to follow. I like to stick with companies that have at least raised their dividends for 15 years, because in the last 15 years, we have gone through the recession in 2008.
Mm-hmm.
We have gone to the COVID pandemic. So by applying that metric, I know that I'm getting a company that even during very hard times, they were able to increase their dividend.
Yeah.
And dividend increase, for me, it's fundamental. If one of my companies have not increased their dividend, or worse, cut or completely eliminated it, for me, it's an instant sell. Doesn't matter if fundamentals are the same or not. For me, it's fundamental to see the dividends being increased every single year. And so I'll reconsider when I'll sell right away when dividend is not increased. I'll reconsider when I started to see changes in fundamentals. I may sell before dividend is cut by analyzing the safety of the dividend, if the payout ratio is getting too much stretched, if there's no free cash flow in the last quarters. So dividend safety, dividend increase, change in fundamentals, and I guess those are the only 3 reasons that would make me sell a company that I have.
Yeah. Yeah, I like that. And I mean, you're keeping it simple too, which is very important, especially when you're first getting started. Like you seem like the type of person like I am, where like you never take whatever you're finding out on surface level. You always want to dig deeper and find out, okay, why is that? How is that? Like all the things. That's one of the like quote unquote traps I fell into when I first started dividend investing, because there's so much to know. Like it's impossible to know everything about everything in general, much less it's very hard, especially in a short period of time, to know everything about even a certain topic like dividend investing. Like I have a YouTube channel on it, and I tell people all the time, like there's plenty of things and it's okay to say that you don't know. That's what a lot of people don't understand too. Is
Absolutely.
so many people just want to have an opinion on something even if they have no idea about it.
Yeah, yeah. And you can understand right away when they don't have when they don't know what they are talking about, by the questions they make or by
Yep.
the comments they make. I wanted to. We were talking about when to sell. There's this book that I read last year, "Dividends Still Don't Lie" by Kelly Wright. And this is the first time that I got presented to the dividend yield theory. I'm not sure if you ever heard about it. And
It
basically,
sounds
what the
familiar, but
book
go ahead and
says,
go ahead and tell me.
what the book says is that for very good companies that increase their dividends every single year, if you check the graph of dividend yield over time, you're going to see that the dividend yield always stays within a range.
Mm-hmm.
So I don't know, Johnson & Johnson, for example, you're going to see that, I'm going to invent now because I don't remember by memory. You're going to see that the dividend yield always stays between 3 and 2%. And what this book says is that you have to buy the company when they are on the inferior limit, like 2% for Johnson & Johnson. And then they tell you to sell when you reach the upper limit, which would be 3% for Johnson & Johnson.
Well, you'd want to do
Of
that
course.
flipped.
Huh?
You'd want to do that flipped, I think.
Okay.
I think you'd want to, because when the dividend yield goes up, that means the stock price went down. So you'd want to buy when the yield's higher, and then you'd want to sell when the yield's lower.
I inverted it. You're
Yeah.
correct. Yeah, exactly. And that's what this book says. Of course, I don't agree with the sell part because I want to accumulate forever my
Yeah.
shares. But this dividend yield theory, to buy when the dividend yields are in the highest levels for one company, is something that I started to apply in my valuation sheet. And it's one of the models that I take into consideration. I want to grab my companies when their yield is exploding, let's say.
Yeah, I mean and that's the thing that's very interesting too, is there's so many, like, between books, YouTube videos, any blog post, anything you can find, there's so many ways to dividend invest, and there's not even anything saying that one or the other's right or wrong. Because I've heard people doing that. I've heard, people bring in like the 200-day moving average. One of the things I talk about in my Power 5 series that I posted yesterday, or at the time we're talking yesterday, is like I do the percentage off at the 52-week high. And some people like the percentage, like how close it is to its 52-week low. And I'm like, okay, like I actually ask people about that, like which one do you like better? And like I got answers for both sides and they both make sense. The reason I picked the 52-week high in the beginning was simply because, like, hey, this company's demonstrated the ability to reach this level. And currently it is, 13, 15, 23% off of that level. But there's no, if it's a quality company, tomorrow, like today's 52-week high will be next year's 52-week low. Like that's just how it works. Over time, it just keeps going up. So that's kind of why I talked about it. But I know some people that they have alerts set for certain stocks to consider buying when it hits at 52-week low. They're like, hey, this stock is now at the lowest point it's been over the last year. I need to get in it right now. Or like that's when they start their research and stuff like that. So, and like you're talking about with the dividend yield, I don't remember what series I was doing or what the video was about, but I remember looking at some website that would show me, like I know Seeking Alpha does this, where like you can see the yield chart.
Exactly. That's where I check. Yeah.
And you can see, like, there's actually I think there's a line. I think it's on Simply Safe Dividends. There's a line that does that too.
Also that, yes.
Yeah,
yes,
where
yes.
it tells you like
but
the
in
average.
Simply Dividends, you just have the last 5 years. In Seeking Alpha, you can check the last 10.
Yeah. So like you can do that. And like in theory, you could say, okay, this is a good strategy to never buy this company when the yield is below the 5-year average, because then it's quote unquote overvalued based on the yield. But then you have to start factoring in, like, okay, did they just raise the dividend? Like, did something happen? Was it a meeting by Jay Powell that caused the interest rates to drop for no reason? And like every stock got hit by 2% or what, like what was it? So, and I know a lot of people, speaking of strategies that may or may not be right or wrong, is like some people just super value the PE ratio. And I really want to do a video, in the future. I was talking to the wife about it. I'm trying to figure out like the best way to do it. Whatever you want to call it, I don't think that the market that we're in, like the US stock market, I don't think this is your parents' stock market. And what I mean by that is like, I think the market's genuinely different than it's ever been. And there's reasons I have behind that. Like there's more, it's easier to access than it's ever been. There's now getting to the point where there's 24-hour trading. There's more brokerages that are often offering dollar cost averaging and fractional share. Well, dollar cost averaging you could always do, but like fractional shares and stuff like that. So like to me, there's more and more money that's going to be infused in the market. And if you just pull back and look at the S&P 500 over the last 100 years, look at the line in the first 50 years, like how small it was. It was going up, but how slow. And then you look at it in the last 20 years and the exponential growth, the compounding that the market's doing. I don't, is there something that's telling you that it's not going to do that for the next 20 years? Where like we could go from 5,000 in the S&P 500 today to like, what's to say we're not at 7,000 in 2 years? Like, what's to say? But it took like literally 30, 40 years ago, the S&P 500 was at like 200. So like, I don't know. So it's one of those things I've just been thinking about. And like, you actually like, you pull up the long-term chart of the S&P and just look at it. Like, look at the chart. Look at what it's doing. It's the same thing you want with your dividend snowball, and I want with my dividend snowball, where it starts real small, but then it goes up real quick at the end. Like that's what it's doing. And like, why does it have to stop? Not to say it's going to be
because in
bull
the end,
markets for the rest.
The stocks is just a paper that represent a business behind it.
Mhm.
Business grow over time. They sell more products, they reinvest, they sell even more, and the snowball keeps going.
Yeah.
So it's just the representation of the businesses that keep growing and growing every year.
Yeah.
You mentioned your theory for the 52-week high. One of my models also that I like to apply is I want to buy the companies at least at 50% level of their all-time high.
Okay.
So I don't take into consideration the 52-week high, which for a lot of cases is the all-time high, but I like to take into consideration the all-time high. And this is one of the models that I take into consideration. Regarding the PE, I don't like the PE so much. I think it's only useful when you compare to the same company, like we were talking about the dividend yield of the same company, and in a very short time, because like you mentioned, the market changed completely, and it will change even more in the next years. So the PE, it's probably the model that has less weight in my sheet, and I just use it to compare with the same with the historical levels of the same company. I want to buy 10% less of the average of the last 5 years. I try to do a little bit of discounted cash flow also to include in my models, but it's something very very simple that I don't even call it discounted cash flow because it's so simple. The assumptions are very, very simple. It's like an offense to call it discounted cash flow for people that do it.
Yeah.
And then what I like to do is grab different models, balance all of them, give some different ways to each model, and come up with a number that it's very, very conservative. All my assumptions are very conservative. And this works for me because if a company for some reason reach that very conservative target price, I feel very safe to put a large chunk of money on that company. And you mentioned before that what it can happen sometimes is that a company comes very close to it, don't touch the target price, and then goes back up. So I have developed something that I call the waterfall strategy. I don't even know if there's a name for that, but I have divided my acquisition in other 2 steps. So before I would make 100% of my acquisition at the target price. Now it's only 75% at the target price. I will make 5% of the acquisition when the company is 10% above my target price, 20% of the acquisition when the company is 5% above, and the last 75 at the target price. So this is something that a way that I found in order to try to leverage on those opportunities that come very near but don't touch my target price.
So what do you do when you have the remaining 75? If it never hits your target price, do you just use that for another opportunity, or?
So 20% of my portfolio is always cash.
Okay.
It is yielding now 5% because interest rates are very high.
Yeah.
But I know that in the future, this cash may yield zero or close to zero. But for me, it's important to always have 20% in cash because I want to leverage in those opportunities that may come in the future. So every capital that I infused every month, 80% I use to make my monthly acquisition and 20% go to my reserve. So I always have 20% in cash. This has to be probably calibrated. Probably during long bull runs, my cash reserves should be higher because I want to invest less in the market during long bull runs. And maybe during long bear markets, I probably should have less cash reserves because this means that I will be buying more when the shares would be discounted.
Yeah.
This has to be yet calibrated, but it's something that also works for me to have every time 20% in cash. We never know when it's going to be the next COVID, when it's going to be the next recession, and I have a watch list of I guess 30 companies. We never know when they're gonna miss some earnings in a specific quarter, and then they're gonna drop 10% just because of that. So I like to always have some bullets in my hand to leverage on quick opportunities. Let's say. What do you
Yeah.
think about it?
No, yeah, I don't know. So I technically have zero extra cash. I mean, so like I said, I buy every day. So it takes me the whole month to spend all of my money. But so for example, APD is a stock that I bought because I watched a YouTube video on it. Of all the stocks I have left in my portfolio, it's my least high conviction because I only bought it because of the metrics that were outlined in a video. That's like my oldest stock that I did that on. Now, any other stock that I have in my portfolio, I identified it as a stock I wanted to own because it met my metrics. Now, APD, like I watched the video on it, it did meet my metrics, and then I bought
It
it.
was
So it
one of
was
my
one.
last acquisitions also.
Yeah, it was one of those things. So, this month in February, APD did earnings, and a lot of people didn't like their CEO and whatever. The stock dropped like 10%, 12%, something like that. So I took all of the money instead of the $80 I was going to put in that stock for the month. I just took all of the money and put it in that day because now it's down a decent amount from what I think my average is like, I don't know, 270 or something like that. And then it went down to like 218 or something. So I just lowered my cost basis a good bit by putting any money there's no sense in dollar cost averaging at that point. Like that's the price I wanted at. So I'm going to get that. So, and then, yeah, so it does that. So that's one of the strategies I do. So I don't necessarily keep cash. Now, one thing I do, that a lot of people like praise my discipline on is, my emergency fund, the wife and I's emergency fund, which is 5 months worth of expenses. I know a lot of people do 6. What we do is we do 1 month in our checking account and 5 months in a savings account. So our savings account, I had a money market account with my bank, and that was like supposed to give you higher interest rates. At the time I pulled it out, I was getting 0.1%, not 1%, 0.1%. And I was like, that's disrespectful. So I started looking into the like SPAXX, which is the default cash position in Fidelity. And I actually did a video on it, like where I'm putting my money and stuff like that. So we put 5 months worth of expenses in there, which is $17K for us. And that we stay there. So every month, that does is that generates interest, which is around $70 off of that cash, which then gets added to the cash balance that I can use to invest the following month. So it kind of like gives me little bits of money by itself. So in addition to the, whatever I said, 833 that we have to invest of capital that we're putting in there, our emergency fund's giving us an extra $70 to put in there. So basically it's giving us $900 of only 833 was ours. So, that's what I did. So, I mean, I technically have that, but the emergency fund's like our life emergency fund, not like COVID emergency fund kind of thing. Like as far as, markets are going down. So I don't know. It is annoying because I don't have, the big capital to do that. But the other thing and like I said before about like going down rabbit holes of like this, and then the other way is like all of them are compelling. The thing that is annoying for me is like the opportunity cost. So I start thinking of that. I'm like, okay, yeah, it's cool. Like in your case, it's cool to have the 20K or 20%. And like, that's super great if and when the market goes down. But depending on how long that takes, the opportunity cost of buying a Costco and it going up 39%, or even buying like the NASDAQ or the S&P last year up 24%. Like, you got your 5% yield on that, but you missed out on 19% from the S&P had that money just been invested. So it's kind of one of those things where it's like, yeah, you can argue it's good and somebody else can argue it's bad. And then like in investing and being the way that we are, you almost just have to be okay with your decision, but don't marry the decision. Like, that's the other thing, is like being willing to adapt and mold the decision as time goes.
Absolutely. That's why I like to read. Uh, I am passionate about financial books. And that's why I like to read also a lot of books that present other types of strategy, like the little book of Common Sense Investing, which says just put your money in an index ETF and forget it. Don't buy single stocks. I have read books about trading. I think we can always learn little pieces of knowledge, little techniques that can be applied also in dividend growth investing. I think value investing goes perfectly with dividend growth investing. Like we were mentioning, it would be beautiful to buy our companies when the yield is at a record high. If we're talking about good companies, of course, not yield traps. So I think value investing goes hand in hand with dividend growth investing. Um, and that's why I like to read lots of books about other techniques also. So with this, talking about the cash reserves, I agree with you. It's something that there's probably not a right answer. I think it's impossible to demonstrate that one way is better than the other. But myself personally, I think I wouldn't be able to stand to lose an opportunity, to not have cash in hands for a next recession or something, that I would go so heavy in my favorite stocks. My favorite stocks, I don't know them because I think they are too expensive. Now, Visa and Microsoft are my favorite ones, and I don't have them because I think they are too expensive. I'm passionate about learning small techniques that can be applied in our investments. The last book that I read, I finished today, is called The Fortune's Formula, and it teaches about something called the Kelly criterion. Have you ever heard about it?
Mm-mm.
So it's something that it's used in gambling, and it's used. It's a way of acquisition. You calculate the probability of you have to win on a bet, and then you grab a fraction of your cash to put on that bet based on the probabilities of winning. And mathematically, the author shows that the gambler money compounds faster with this criterion.
So that's saying that if your bet has a 36% chance of hitting, you put 36% of your money on that thing.
It's not exactly direct. There's a formula to
Okay.
calculate the fraction. But what I love about the Kelly formula is that independent of what is the probability of winning in your stock choice or on gambling, you are never gonna put 100% of the cash you have. Because if you put 100% of the cash you have, there's always a little chance, even if it's minimal, that everything goes to zero and then you cannot compound anymore. So it's always a fraction of your cash reserves. It doesn't matter if they are very big or very small. It's always a fraction of your cash reserves. So now I'm trying to adapt it to my investment strategy, because I think it goes very well with managing the cash reserves and managing risk. Because in the end, for me, in dividend growth investing, managing risk means two things: buying very good companies and buying with a margin of safety. For me, managing risk, it's this, nothing more. What do you think about it?
Yeah, I mean, it's important. Like I said, the thing that's gonna be so difficult, and because I can speak on this because it's literally what I've gone through as well, is like especially anybody that writes a book. Anybody that writes a book has really good knowledge about whatever they're writing the book on, hence why they wrote the book. The issue is, I feel like anybody that does that has enough knowledge to convince you of whatever it is that they're trying to do. So you almost have to like read the book that's against the book you just read take both sides of the argument and then not even like meet in the middle, but make your own version of the two of them. It might be 60% of the beginning of this and 40% of the end of that one, or whatever combination it is of those two things, and marry it and make your own thing. Cause like, it's just so hard. Like, you read a book, like Steve sent me his book for closed end funds, and I'm not like a giant reader. I'm more of like an article. Like I just can't keep focused that long. Now I guess I could read like a page or two at a time, but then that takes the rest of my life to read a 20-page book. So, but like I like videos a lot more, and like podcast and like hearing it and stuff like that. That's just how I learn. But like when I get done reading Steve's book, it's all on closed end funds. And of course, like Steve really likes closed end funds and all that kind of stuff. Like he knows all about them. He's been doing them
I
for
bought
decades.
his book this week, by the way.
Yeah. So it's all like, and like, of course, like in my head, me being like the type of person I am, I'm like, of course, Steve likes these. He knows about them. He's been doing them for decades. But of course, he's going to say good things about them. Like that's what his book's about. He's an expert on closed end funds. Now, what is the other person's point of view that doesn't like closed end funds? Why don't they like closed end funds? What do they like instead? And then it's like, okay, like, is there another point of view from the two of them to like something else? And like, okay, let's read all of those, or let's understand all of those, and then make my own version of the mix of the, like, I might take 5% of what Steve says and then 20% of this, and then, whatever the 75% of the other one, and make it my own thing. So, I mean, it's just one of those things about what you're saying about like margin. Obviously, like nobody's going to say that you want to buy like the opposite of what you're doing. Like they don't want to buy bad companies at very high valuations. Like that doesn't make any sense. Like that doesn't make sense. But like I said, it's always opportunity cost. So it's always like, okay, you like Microsoft and Visa, two stocks that you don't own. Like I've said this 100 times. I don't know if you've seen the interviews I've talked about it on, but like with Costco, I had NVIDIA. I bought NVIDIA because of the Dividend Growth Investing Group, because everybody was just like, NVIDIA. And this is 2, 3, 4 years ago. So I bought it and I looked at it. I was like, okay, it does outperform the market, but it doesn't constantly raise its dividend, and it doesn't grow therefore it doesn't grow its dividend at the rate I like them to grow. So I was like, okay. And this is before I did my active and dormant. I really wish I would have had this because I'd have kept it. But I was like, okay, it doesn't meet. I'm going to sell it. So I sold it, and I had a 55% gain on it. But of course, after hours, it goes up, 24% or whatever, after earnings, which was annoying. But I took that money. I helped balance out the rest of my portfolio, started a new position in Costco. I identified a company I liked. It met the metrics I liked.
Amazing company.
I did not care what the stock price was. And had I, according to PE, Costco is always overvalued. According to this metric, that metric, this metric, Costco is always too expensive. Always. 100% of the time. I don't think you could ever pull up a chart where Costco is fairly valued. Maybe during COVID. But like, had I not done that, Costco is my number one performing position. I also just got $15 per share in special dividends. So I almost got $100 because I had almost 7 shares. It was like 99.11. So I did that. Like I said, it's my best performing position. And had I said, I want Costco to be fairly valued, I might never have owned Costco, ever. And to me, like, that's the opportunity cost I was just talking about before. We're like waiting to hit that. And I do like your strategy of a certain percentage at this percent, a certain percentage at that. Like, that's a good way to make sure that you're getting into some companies. But at the end of the day, like I always like to think of like the counter argument. The counter argument is certain companies are very good for a reason, and they don't hit these random numbers people pick. They just don't. Like Apple might dip a little bit, or Microsoft might dip a little bit, or Visa. But then what do you notice? Next week, they're back where they were. It's not like, oh, they dipped 4 or 5 weeks in a row. Like that doesn't happen. These companies are great companies for a reason.
And I think that's the beauty about the discussion. There's no right answer. There's no right strategy. You always learn a bit more of information, and then you may change sides. My best performing stock is Aflac. And when I bought it, I still was not performing these valuation models that I like to perform in order to buy something with margin of safety. If I would have applied it, I wouldn't have bought it because it was expensive, and it is my best performing stock. So I know exactly what you were doing.
Hey, see?
Still, it's about.
Okay, here's one thing I want you to do, just for fun, because you're still very new in investing. What I want you to do is anytime you identify, like, and obviously don't just like look at the market every day and be like, oh, I like that stock today. Like, do it on a conservative basis, by, oh, I'm really interested in adding a stock. I identified this stock. It met the metrics I liked, except for the price. Just write it down. Write when you did it, the date, the time, and what the price was. And just like test your theory. Because it's important to have the theories that you have. And it's, like I said, it's important not to marry them, but being able to have them be flexible. So start doing that. And then to say, okay, I would have bought this on February 14th. At this time, it was this price. The reason I didn't was because it was too high. I set the price targets at this. Then look at it in a year and be like, okay, did I ever buy it? Did it ever hit the price I wanted? What would my gain have been had I just bought it, ignoring the price, or maybe reconsidering some of those options? And just like start writing that, like you have your journal of saying why you bought the stocks you bought. But maybe have like a little separate part of a journal where it's like, hey, here's the stocks I would have bought had the price been what I was looking for. And like just do a little case study on that. I'd be curious to see how that goes.
Yeah, man, I agree. It works. In the end, we are talking about good companies, and good companies, the stock price will increase in the long term forever.
Mm-hmm.
For me, it just works more to have some cash reserves that are yielding nice now.
Mm-hmm.
In order to leverage on something like it happens with APD this month, or may happen with any other company. End of last year, I was able to increment my position in Realty Income O, which is probably one of my few low dividend growth stocks. My entry price was 47. I thought I was never be able to get it 47, and end of last year it touched 47. So I just need to have my cash reserves in order to leverage on the opportunities. Also, it makes me less volatile, because if my 20% of my stocks of my portfolio is in cash, it means that I will never go as down as the whole market, but of course I'll never go as up as the whole market.
Yeah. Well, and the counter to that would just be like, you have so much time. Like you have, you're, even if, so actually the next question I wanted to ask you is like, what are some of your short and long-term goals? Because like some people want a dividend portfolio to, just fund their vacation every year. They just want, okay, $4,000 or $5,000 to be able to go wherever they want once a year off their dividend portfolio. Me, on the other hand, I want to be able to live off the dividend portfolio, and I don't want it to just be me. I want it to be the family. We're supported by our dividend portfolio. So like, what are some of your goals for that? Like, what do you see with dividends?
Yeah, for sure. Our family goal is to live off from it. We come from a country where you can't count on Social Security to pay your expenses after you retire. So you have to have a plan. And then for me, dividend growth investing is perfect, because when I reach retirement, I don't have to do anything. I don't have to sell everything, put it in a money market or something, and live off from it. I'm just gonna keep doing what I started to do last year. I'm gonna do it for the rest of my life. I'm gonna be retired, and my payments are gonna be increasing every single year. It just makes too much sense, and we want to live off from it. We are very far from it. We have just started. For sure, there are going to be periods when we're not going to be able to infuse new capital, but there's going to be other periods that are going to be able to put a lot more capital than we put it now. So from our calculations, things will be fine when we reach our retirement age. Our goal is to live off from it.
Are you trying to retire, or like what's the retirement age where you guys are at? And like, are you trying to get there before that or around that time?
It is around 67.
Okay.
And I'm not sure if the goal is to retire early, because we both like our jobs a lot.
Yeah.
But for sure, to work just because you want, not because you need,
Yep.
completely changes everything.
Yeah. Yeah. When even the people that I know that like their jobs, like the only thing that they like more, well, one of the only things they like more than their job is their free time. And like you said, being able to spend that however you wish. So like whether it's saying, hey, I'm going part-time at my job, and then if your company doesn't like that, hey, I can go no time at my job if you really like, if you want to push the envelope. Like, I don't need this, I just enjoy it. So it is about that flexibility, and that's what people like it. So one of the questions that I didn't really want to get into, because you have just started, is like, how has your investing style changed from when you started to now? You kind of spoke on that with like You did fall into the yield stuff at first with AT&T and Zim and stuff like that. How has your knowledge increase changed the investing style of your wife since you started?
Now, this is a good question. She doesn't put so much time as I do on studying, investing different strategies and so on. Uh, I've been reading more or less 2 books a month. As you mentioned, you prefer like to listen to a podcast, watch YouTube videos. For me, it works more to read books. And she trusts me a lot. Usually, I do the operations for ourselves. She started to choose some dividend growth companies herself. She has just invested in Novo Nordisk,
Okay.
for example. She has CVS in her portfolio. So she got me into the investing world, and I got her into dividend growth
Yeah.
investing. So, and I think that's how couples should be, right?
Yeah.
One makes the other better, right?
Yep. Yeah. So I mean that's really cool. It's like I think about all the time, like my wife and I met, we both worked at Toys R Us. We met there. And she knew I was a big Thunder fan, so she brought me to OKC, to Oklahoma, for a Thunder game. And we were here for a week, the whole thing. We were here for a week. We only were at a game for one day. So we had 6 days just to walk around and do stuff. And we noticed how cheap it was and stuff out here. And I always wonder, like, had I not done that, would I have been with a different friend group where we were? And like, it's always the cause and effect. And that stuff's always so cool to think about. Like, had COVID not happened, I was always a really big saver. But as you know, it's not impossible, but it's very hard to save yourself to wealth. Like trying to save a $1.5, $2 million bank account, very difficult. Trying to invest to a $1.5, $2 million bank account or investing account, still difficult, but way easier because you have more time and compounding and money's making money. Versus my 0.1% interest from my money market account, I'd have been doing that till after, like in my next life, I would have been doing that. So it's kind of one of those things where it's, so I think that all the time. Like, had I been still in Pennsylvania, would I had the same interest that I had? Had COVID not happened, because I started watching videos from like Andre Jick and Graham Stephan and those guys, and Andre was really big into dividends and he was talking about it. And then I remember signing up for Robinhood. I got my free stock. It was SiriusXM. SiriusXM paid me a 1 cent dividend. And I was like, what's a dividend? Do I owe this to somebody? Like, what's going on? And that triggered everything that I'm doing today. And I'm just like, it's so weird, the butterfly effect. And same thing with you. You used to be a saver and stuff like that. Then you met your wife. Your wife got you into investing. You went down the rabbit hole of wanting to know more and all kinds of different investing. You start reading books. Now you got her into dividend investing. Like, had you not met your wife, you might have never gotten into investing in general. And it's just crazy to think about that.
My cash was parked on my bank account yielding 0%
Yep.
for years.
Yep.
For years.
And that's just, like I said, not to say it's impossible to become wealthy off of doing that, but it sure is a heck of a lot harder. That's what I was trying to say. But like, it's one of those things where, like, the market last year went up 24.45% or something for the S&P 500. You would have got 0%.
Yeah.
Like, that's 0% for you, 24% for the market. And that's what people, I don't know if it's as bad over there as it is here, but they talk about like the middle class and the upper class and lower class and stuff like that. And they say how the middle class is disappearing and stuff like that. I often think about it. The middle class is like, not that everybody starts in the middle class, but like the middle class to me is like the start point. And based on the decisions that you make, you go to either the lower or the upper class. If you want to have a lower class mindset, you spend more than you make. You have consumer debt. You don't invest, like stuff like that. And that brings you to lower class. What takes people from lower class or from middle class to upper class is the people that save a lot more or invest more than they spend. They reduce their income. They don't have consumer debt. They don't have reoccurring, like they reduce their monthly expenses so much, and they invest their money so their money makes them money. And like, that's how that's why to me, the middle class is going away. Cause it used to be like upper class, lower class, middle class is obviously everything in between. Well, now it's like, okay, the upper class is going away, but then the lower class, technically, if you look at it, and then one of the podcasts I listen to talks about this, The lower class today has so much more than the lower class 50 years ago. The lower class 50 years ago, you went out to eat once a month if you're lucky. You had one car, one person worked. There was no streaming services and everybody had a cell phone. Like it was like one, like that was lower class. And now you get into it. Okay, you might be lower class, but you go out to eat a couple times a week, or you have two cars, everybody in the house has a cell phone, you have 4 different streaming services, and that's considered lower class. I'm like, well, at that point, that's like a mentality thing. Like you have a lower class mentality. And because you don't do anything to change that, it's not going to change.
You know what? I think it's all about the time value of stuff.
Mm-hmm.
How many hours of your job does it take, or did it take to buy your house? Make the same calculations 20 years ago, and you're gonna be able to see if the opportunities were the same or not.
Mm-hmm.
And it's easier now, by the way.
Yeah. I mean, yeah, like
And
the worse off like the low end of what people have now is like what rich people used to have 50, 60, 70 years ago. Like it's just wild. And I don't know, like I said, to me, it's a mindset thing. Like if you are
exactly.
like, they do studies all the time where they talk about like the amount of money that people make that are still living paycheck to paycheck. And some people are making $200,000 a year and living paycheck to paycheck. I'm like, you don't have an earning problem. You have a spending problem.
I think when you decide to invest your money, you are somehow becoming a better person.
Mm-hmm.
Because as you said, it's a mindset. Because when you start to invest, you start to study more, you start to watch more videos, read more books, you start to convince people around you, you start to focus your time on stuff that matters more. Like you said, you're not going to spend more than you earn, so you're going to do less stuff, and then you're going to focus on stuff with quality. I think in the end, when you decide to invest, somehow you are becoming a better person also.
Mm-hmm.
I think that's the thing.
Well, you're just really like, to me, when you do that, you're really establishing like the basic thing that they taught us in school is like the difference between wants and needs. And like you're recentering on that and realizing a lot of things in your life that you think makes your life better are built off of wants, not needs. Like there's a base level of life that everybody can live, but to me, you have to sacrifice some of those wants in order to have less needs. Like I have less needs than I had, like ever. Like we don't have a lot of stuff. We reduced our expenses, stuff like that, to the point where we're able to save a lot for the house. We're able to invest a lot of money. And it's difficult, like even to the wife or even to anybody that I talk about, to tell them like, hey, we're doing less now so we can do more than we can ever think about doing later down the road. And some people, like it is hard. Like even for me, I'm investing, I see the spreadsheets, all this stuff. It is scary to think, what if it doesn't work? What if we do this for 30 years and it doesn't work? Like, what if we make all these sacrifices and stuff like that? And then like, oh, okay, I was supposed to retire at 50. Well, I look at it like, oh, my dividend portfolio is only bringing in, 10 grand a year. I can't retire off of that. Like that's scary. But like, it's also, there's a 0% chance it works if I don't do anything.
Exactly. I think, as you mentioned, we were talking about goals, what are our goals with investing? When you start to live with a very clear goal with your investments, you know why you wake up, you know why you go to your job and do it. You want to do it better because you want to earn more, because you want to reach your goal before. So I repeat, in a way, we become a better person because we have set our goal, we have a plan. Suddenly, everything that you do has a sense. You know why you are doing it. So I think it completely changes us for the better when we start investing. And for some reason, back in Brazil, in my country, now here in Europe, this culture, it's not common sense.
I
In the
was going to
US,
ask you that because like when I talk to people, whether it's at the gym or the grocery store or wherever it is, Thunder Games, like so during COVID, everything went down. Right after COVID, everything went up. People got into investing. They weren't investing in the quality things, but anything that they invested in went up. So it's one of those things where everybody thought Hey, investing's easy. I can buy whatever thing I want. I can buy my GameStop, or I can buy my AMCs. I can buy my Dogecoins or my Shiba Inus or whatever they want to buy. And everything goes up because that's how the market works. Then the market did its thing and got rid of the crap, and now the good things remain. People assume that investing's a scam or like it doesn't work or whatever, yada, yada, yada. But like here, when I talk about it and I say, do you invest? That's the stuff that people think about. They don't think about the buy and hold quality companies for 40 plus years. They think about, I did that investing thing. It's not for me. I'm like, when you say you did that investing thing, you bought some GameStop in 2021. Is that what you're talking about? So is it the same over there where like you're looked at like you're the weirdo for investing?
Man, I'm sure it's probably worse here
Wow.
because if I go check YouTube, for example, the grand majority of channels like yours, it's from the US. You're not gonna see so much European channels, not even Brazilians. When I talk about the stock market and how I feel safe about having all my invested money in the stock market here, people think I am completely crazy. Because for them, the stock market is about, like you mentioned, buy an asset, buy a company, hope that it goes up, and then sell it at some point, and then repeat it forever. And
Well, they
when
don't do
I
anything with dividends either. Like theirs is just the growth plays, like an Amazon or a Tesla or something like that, where everything that they make money or lose money on is strictly based off the stock price.
Exactly. For them, dividends, it's a waste of money. There's the problem of taxation. Dividends are taxed if a stock goes up. One of the things that I hear a lot against dividends and against dividend growth stocks, and that I disagree so much, is usually people say, dividends is not free money. Dividends are discounted from the stock price. And I don't like companies that pay dividends because they don't know what to do with their money, and then they pay their shareholders
Yeah, they
because they
grow
don't have
less or
nothing
whatever.
else to do with it.
Yeah.
And I disagree so much because I think more and more, and we can see it now, Apple doing this, we can see Microsoft doing this. Meta has just started paying its dividends, and I'm sure they're going to increase their dividends every single year because companies are finally understanding that to pay dividends, especially increasing dividends, it's good for their business, because when you pay increasing dividends, you are attracting high quality investors. And by high quality investors, I mean the investors that are going to buy your stock and they're going to hold it for a long time or forever. And you want as many of those for your business, because the more buy and hold investors you have for your shares, you're going to have more demand for your shares, and stock price is going to rise. In my vision, dividends make in the long term, dividends make the share price rise. Okay, there is the discount on the ex dividend date, but it's not even perceived in the same date because of the daily fluctuations. And in my opinion, dividends make the stocks goes up. And when people say that a company pays dividends because they have nothing else to do with their money, I don't agree, also because I think growth is limited.
Mhm.
I think if one company chooses to pay 10% of their earnings in dividends, is not because they are choosing to grow more. It's because growth is limited, and I'm going to grab part of the earnings without sacrificing growth, and I'm going to distribute it with my shareholders in an increasing way because I want shareholders that stick with me.
Yeah, I
And
agree. I'm really glad you said what you said about like, because I thought that too. Like to me, a company that pays a dividend, it's a reliable dividend, and the shareholders can see that, it creates less volatility within your stock because, like you said, there's incentive to hold. Versus like, so I could argue this, and like I don't know if this will ever happen, but I own Tesla in my Roth IRA. It's my only non-dividend paying holding in my Roth IRA. It's Tesla, and all the other ones are actually ETFs. Because I wanted like more hands off kind of thing. I could argue Tesla's one of the more volatile stocks. Like that's not really a thing to argue. Like that's just a thing people know. I could argue if Tesla started paying a dividend, even if it was like 5%. Now, obviously, Tesla's like hyper growth right now. So like they're not worried about that. If they started paying a dividend, I guarantee you their volatility would go down because you'd have more people that are more likely to say, hey, I'm not just buying this because, oh, I know Tesla's volatile. I can buy it at 188. I know it'll go up to 211 next week. I can sell it and do it again when it goes back down to 188. Like, you'd have less people doing that. So then it would go from 188 to 200 just because people would hold. And then it might go down from 200 to 195 and then back up to 205 or 211 or something like that. But like, it would have almost like a new base to a point where it will never go to zero, because you're going to have, as long as people are what they say they are and they're long-term holders, it's, to me, I feel like it's almost impossible for a stock to go to zero if you have 40, 50, 60% of your outstanding shares that are always held and never sold. Like, the stock price just can't go down below a certain point because there's not that, like, that's just how it works. At least in my head, that's how it works. So,
Man, this reminded me of something. Like you said, the stock can't go down. I agree 100%. And also, I learned this in this book that I showed you before, Dividends Still Don't Lie. And this book explains to you how dividends protect a stock from falling completely. Dividends act as a shield against price drop, because when good companies suffer a very abrupt price drop, the good shareholders will buy more shares because the yield is screamingly high at that point, and this will avoid the stock to fall more.
yep.
So in a way, dividends act as a shield against price drops. Also, I think it's the healthiest strategy one can have when investing is dividend growth investing. Because, man, if my goal would be just to see my total balance going up over time, I would be completely crazy, because when you invest in stocks, your total balance, it's
Yeah. And
always
it's out
like
of your
this.
control.
Of course, if you we invest only in good companies. Of course, our total balance has to just go up with the over time. But my goal is to see my dividends increasing, and I see my goal only increasing every single year. Every single year I'm closer to my goal. Doesn't matter if it's a bear market, doesn't matter if there was a pandemic. Every year I'm closer to my goal. Somehow I think it's healthier to live like this, or to invest like this.
Yeah. Yeah. At the end of the day, it's like the world we live in now. It's fear based, like fear sells. Like, if I make an optimistic video on the YouTube channel, it might not do well. But if I put some fire behind me and some explosions or whatever, and be like, hey, stock market's going to crap, everybody be like, oh, I got to watch that. Why is the stock market going to crap? It's just not it's not attractive to me to do that. So I just stay away from that kind of stuff. But one thing that I did want to, like, as a little experiment, like, especially for the people that know about investing, that you talk to about, I hear that all the time. It comes out of the stock price, whatever. Bring up, like, in a long term, like, I don't know, like a 5 or 10 year chart of Apple or Microsoft or Visa or whatever, and just bring up the whole chart, put it on a piece of paper, like a landscape piece of paper, so they can really see all the dips. And I say, point to me every time a dividend was announced. And they're going to point towards, like, the biggest drops. And then you have a separate sheet that you already labeled. Like, actually, that one was COVID. That was bad earnings. That was interest rates, like that. And, like, you're like, yeah, you want, and then what you do is you bring up a third sheet and you show them on the long-term chart. But, like, see that little drop that you can't see? That's the dividend coming out of the stock price. You see how it doesn't matter in the long term? Like, even if it does come down by a little bit. Oh, there's a website called dividend.com. They have a chart at the very bottom of the thing. When you search for a stock, it tells you the average, or not the average. It tells you exactly how long it took for the stock price to recover once the dividend was taken out. And a majority of the high quality companies, it's 0 days. Like, literally the day it comes out, it comes back.
Exactly.
And then,
You
like,
don't
you have
even
your lower
feel it.
quality ones where it's like, oh, okay, like a big yield came out. It took 36 days for the stock price to come back or something like that. And I'm like, yeah, that's the difference. Is like, when I buy Apple, I don't even notice. And because I dollar cost average every day, I'm excited when it does do that, because I get it for 0.5% cheaper anyway. I don't care.
Exactly.
Like, that doesn't matter to me.
Man, when someone comes with this speech that dividends is no free money, it gets discounted from the stock price, or that a company has nothing better to do with their money, so they just distribute it, I immediately think they have no idea about what they're talking about. They have no idea what dividend growth investing is about. And for me, this argumentation is the worst one. I, I, I for me, it's completely wrong. It's not a different opinion. It's wrong for me.
Yeah. Yeah. At the end of the day, like, when you first start like a new job and stuff, like the hardest part about like training is they're like, okay, make sure you ask any questions. You're like, I don't know enough things I don't know what to ask. You don't know what you don't know kind of thing. And like what you were saying, I get asked that kind of stuff because I'm a competitive level power lifter. So when I'm in the gym and like lifting whatever weights I'm lifting, I get all kinds of questions from different people. And I can always tell like who just started in the gym or who doesn't go to the gym or who's getting all their information from certain places like TikTok or whatever, because by the questions that they ask me. And like I don't make fun of it because I'm like, okay, like at least they're asking the question. But like I'll get a question just like, what supplements do you take? I'm like, dude, do you know like a supplement, like best case scenario, you're gonna get 5%, 2% of what you put out, you're gonna get from a supplement. Like creatine's very good, and that's like 2%. Everything else comes from like your sleep, your stress, your training, your diet, like all kinds of stuff like that. Those are the big rocks. And somebody asked that kind of question. It's the same thing with investing. Like when we first started, I tell the story all the time. I actually backwards calculated dividend yield because I didn't know what dividend yield was. So I was like, okay, if I put in $100, how much am I going to make off of this stock? And it was like AT&T, and those guys were at the top. It was like, oh, I'm going to make 7 cents off of $100 I put in this. That one's a good one. And like, I didn't buy those, but I made like a separate like practice portfolio of all the highest ones back. And then I ended up looking at it years later. I was like, why did I just like, I literally could have just looked at the dividend yield. That was what I was calculating. But, yeah, it was, I don't know. It's just one of those things. Like I'm trying to figure out ways to get more people passionate about investing, which is one of the points of the channel. I started the new series, Anyone Can Invest, on the channel for that exact reason, where it's attacking the thing of like, I don't have enough money to invest. That's not a thing anymore. It's you can do it for $1. You have fractional shares. You have all kinds of stuff. Like you literally can buy any company. You can buy Berkshire Hathaway for $1. Now you're not going to have hardly any of it, but you're going to have some. If Berkshire Hathaway goes up 100% in the next 5 years and you have $1 in there, you made 100% on your $1. And it's just one of those things where I try to do what I can to educate about it. I'm trying to figure out different ways, whether it's like a shirt or a hoodie or business cards or whatever, where when I talk to people and I like, maybe I put like a picture of like, I just thought of this when we were talking, like maybe I put a picture of the S&P 500 stock chart just on the back of the hoodie. And it just says, are you missing out? And like, people are like, hey, like what, like, am I missing out on what? Cause like people don't like to miss out. They have that FOMO. They don't want to miss out. And like, that's really what it is. Like, hey, and going back to that video idea I have about like, this isn't your parents' stock market or whatever I'm going to call it. Like that, it's a exponential growth. And what's to say we don't look at it 50 years from now and this big growth that we're seeing today it doesn't look exactly like it looked 50 years from before us, where it's just this little growth. You're like, oh yeah, look at that. It was barely growing. And now it's just freaking straight up into the moon. Like I said, there's going to be down times. You're going to have another COVID or another whatever, or another recession or bear market or whatever. It's not going to go up and to the right the whole time. But when you pull it back, it does. That's just what happens.
Yeah. Man, I was thinking about it while you were saying it. Why people sometimes are so reluctant against investing or starting to invest. And my reading on this is that, especially for older people, when you start talking about investments to them and how it works, it's you somehow are telling them how much time they have lost. And I think that's a pain they don't want us to point out, or they don't want us to touch that part.
Ignoring it doesn't make it
one
not
of my
true.
interpretations.
Sorry? I said ignoring it doesn't make it not true. Like
See.
it's still like I have to record these and I'm trying to figure out how I'm going to put it out. But I did a chart that I wanted to know how much would getting the average return of the S&P 500, which is anywhere between 8 and 12%. So I did all three, 8, 10, and 12%. How much would you have to invest every month between now and the time you're 67 in order to have $1 million in your account? Obviously, I know $1 million 67 years from now isn't going to be $1 million. Whatever. It's still $1 million. It's just what you can buy with $1 million. But anyway, and so spoiler alert, if you got a 12% return and you started an account for like a newborn, you'd only have to put $6 a month in that account. From now until they're 67, they would have $1 million. Fun fact, if you want to do the math, that's like $2,484 of money you added over the course of 67 years that would have turned into $1 million. And just stuff like that. Like, it doesn't change the numbers, but what does change the numbers is you ignoring it and kicking it down the road. Yeah, okay, you did miss out on investing in your late teens or in your 20s or in your 30s or however, say you're 45 years old. You missed out on, 25, 30 years worth of investing. But by ignoring it, now you're going to miss out on year 45 and year 46 and year 47 until you finally say, like, a lot of people, I don't know if it's the same over there, but a lot of people are just like, investing, retirement, saving for retirement doesn't even kick into their head until they're in their 50s. They're like, hey, I got to start thinking about like when I want to retire, when can I retire? And like by waiting so long to ask that question, the answer becomes further and further away. Where if you ask yourself that question when you just start working or when you're in your 20s or in your 30s or whatever, when you ask yourself that question, it can be closer than you think.
Man, imagine a family that went through several different generations, and the first generation taught their children about investing, and those parents, they invested their whole life. In the end, their money passed to their children, and it goes on and go on through the generations. This family would be completely rich.
Yeah.
It's all about, I don't know what is the secret. What I try to do is talk about it as much as possible. I changed my parents. I've started to change a few friends because I talk about it passionately. I show them my results, what I'm getting without working. It's difficult, man. I guess doing what you are doing is the way. Just talk about it, and but there's a long way to go for people to generally understand what the real benefits of investing.
Yeah. And it's at the end of the day, whether, you invest, whether the person I talk to at the gym invests, I'm invested. It doesn't matter to me. Like I'm just trying to do it because I know it's good for whoever I'm talking to in the long term to do this for themselves, do this for their family. And like you were talking about, like imagine a family, like that's what we're doing. Like as soon as I got my social security card for my son, I put him on my credit card. So my son has a credit card. He just turned 1. So by the time he's 18, he'll have 18 years worth of credit card history, which should give you close to a perfect credit card score. And then he has his investing account. I have him just in ETFs for now. The goal is, when he gets, 7, 8, 9, 10, whatever the age is, he'll start asking me about it and I'll explain it to him. This is what we're in. This is why we're in. Here's our goal. Here's our plan. As he goes to school, maybe he starts to hear different things that kids like and stuff like that. And he can tell me, hey dad, so-and-so's into this. Like, let's look and see if what company are they part of? What else do they sell and stuff like that? We can start looking into stuff like that. And like I said, worst case scenario, he doesn't get an interest on it. He'll at least have the education on it and he'll have his own account that he gets at 18 years old. I'm not paying for his college. He can use that for his college. He can keep it in there. He can do whatever he wants. Like that's up to him. So, and it's just really cool. Like you said, it's in theory. So I have a evolutionary theory about this. So in my head, this is what happens is like you have the family generation that starts from nothing, right? Like we always hear, like whether it's our parents or our grandparents or whoever it is, they came here with nothing, whatever they say. They grow up, they want more for their kids. They give more to their kids want more for their kids, and so on and so forth. So it keeps going until you hit the point where that generation is so far disconnected from the pain and suffering that they become lazy and entitled. And what they do is they reset it. And then what happens is they don't have any discipline. They don't have any motivation. They think everything in life just happens. They raise their kids that way. They don't give their kids any like morals or standards. They restart it. Maybe not from the same exact place, but somewhere close to where it was 3, 4, 5, 6, 7 generations ago. And then you have to redo it all over again. And I think that's just what it is. And ideally, best case scenario, like you were talking about, is it never resets. There's some kind of rule book. There's some kind of plan. There's some kind of video or documentary or whatever. And like, who knows, 20, 30 years from now, I don't know, YouTube's going to exist. But like if it does, and my kid has a kid, he can go back like, hey, look, you see how well off your grandpa is. Like go back, look at this video that he made where he was making $200 in dividends. Now you know he does whatever he wants whenever he wants. Like that's how it starts. It doesn't start with you have $1 billion in the bank account when you're born. Like that's not how it works.
That phrase you mentioned, it's very used to describe family businesses. It says that the first generate creates it, the second generation enjoys it, and the third generation destroys it. Because you lose this attachment with the creation and the suffering and the hard work. You were talking about your the investments for your son. You mentioned ETFs. I wanted to know what is your opinion generally about ETFs. Mine is that I think it's one of the most genius inventions in this century. I think it works for everyone. I think depending on your choices, it may be even better than picking single stocks for dividend growth investing if you just stick to VOO and SCHD. I don't know. But I think I prefer to choose my. I have 30% of my portfolio is ETFs, but I think single stocks is for people that enjoy the process of researching, studying, getting better. I think it's about enjoying and having time for the process. What do you think?
Yeah, I agree with that. So what at the very end of the interview, I always ask like tips for your younger self or tips for somebody new. Literally the thing I always want to mention in every interview at some point is if you are watching this and you're not into investing, which I don't know why those would be things, but if pretend you're the one watching it, you're not into investing. My suggestion, not financial advice, get started with VOO or the NASDAQ or something like that. Just put money in it, put $100, $200, whatever you can afford. And like, don't say, oh, I got to make sure I go out to Chipotle 15 times a week. I can't afford any more than $25. Like really like rein it in and realize that this could benefit you for decades or generations down the road. Put $200 in there every month into VOO. Then ideally, like the evolution of this, and not even ideally, just in theory, one of the evolutions of this could be, hey, the S&P 500 is doing really well for me. Hey, the S&P 500 pays a dividend. What makes up the S&P 500? Then you can start like, oh, okay, it's the Magnificent Seven, own 23% of the S&P 500, or not own, but they're the 23% of the part of the S&P 500. Oh, a dividend is when a company pays you back part of its earnings. Oh, and like you can start just going down that route. And if you do get an interest, you can start dabbling in the individual stocks. Like I said before, my channel would be very boring if I was just like, yep, this month I bought 3 shares of VOO. We'll talk to you next month. Like that's, I can't do that. So like, that's why I have all my ETFs in my Roth where I do that. And then I do all my individual holdings in my taxable account that I'm going to use to retire early. The goal is to beat the market. Most people don't do that. So it's one of those things. I 100% agree. I think ETFs are great. I think everybody, so if I had a suggestion for people, not financial advice, if I had to start all over, I would probably make it to where my first $10,000 that I invest had to be in an ETF, like VOO. And I'm building up a base. And then from that point, I can spiderweb into what I want. Because I think that you learn so many things in the time it's going to take you to build $10,000 into VOO gives you plenty of times to figure out a strategy. Like there's all kinds of like paper trading apps and websites and stuff that you can go to where you can like test that strategy with like digital money that doesn't really exist. And you can be like, okay, I like these stocks for this reason. I'm going to buy those with this digital portfolio. I'm going to see how it would have done. And it's different stuff like that. And you can just gives you time to learn all while building a nest egg of sustainable growth, whether you learn something, don't learn something, whether you want to do it full time or not do it full time or whatever. So
I wanted to ask you, what's your opinion about SCHD, since this is a dividend discussion. I love SCHD. I think it's an awesome ETF, and it really grinds my gears when I see people in the Facebook group, for example, saying that, oh, what's happening with SCHD this year? And then they sell it, and they don't even try to understand what is SCHD, what is inside of it. like if you check the S&P 500 last year, it was flat if you remove the Mag 7. I guess it was up 4% or something.
Mm-hmm.
The SCHD doesn't have the Mag 7. It wouldn't grow as much as the as VOO did, or a Nasdaq ETF, for example. So it really bothers me when people don't even understand which companies are inside SCHD, and they just sell it because it didn't perform well last year or in the last couple of years. For me, it's a beautiful ETF, high dividend growth. I think it's around this last year was quite slow, but I guess the 5-year average is around 8% or
Mm-hmm.
something. I'm not sure. And the starting yield is quite high, also maybe around 3% or something. What's
Yeah.
your opinion on it?
Yeah, I think I want to. So it's so hard to do it at the current time, but I think it's amazing to literally look back on like things that are trends and like how quickly they turn into enemies. Like if you would have looked at SCHD in 2021 or 2022 on those same groups that you're talking about, like favorite child, crown jewel, everybody loved it. Like you couldn't find a post on there that wasn't talking about SCHD. It was all over the place. It has one bad year, and that's all it takes. One bad year, everybody sells. It doesn't matter if the person talking about it is 64 and they're selling it for good reason because they can't have bad years. They need to preserve capital. Or if the person talking about it is 18. They think the shoe fits for everybody. And I think that's wild. And like one of the things that I always thought was cool about SCHD is it follows a lot of the same strategies that I follow and like that you follow. It's just an ETF that houses those things. And so as you know, and anybody that's watching, the internet has plenty of things to say about plenty of things. When I created my strategy, and it was really simple and, not looking into a lot of metrics, not looking at price, all that stuff, I actually posted my metrics on that page. And I said, hey, I am issuing a challenge for the internet, which, is great at challenges. Tell me why find me a stock that meets my criteria that is a bad stock. People found stocks that almost met my criteria. They were like, this one does it, but like it doesn't meet this or just slightly underperforms yet. I'm like, no. The cool thing about Excel, when you do your filters, it doesn't include everything that's kind of close. It's either that or above. Like that's how it works. I was like, no. Like it meets my criteria or it doesn't. Find me a stock that you don't like. And I got a bunch of comments on it. None of them were stocks that like nobody gave me any stocks. Some people were like, oh, this is really cool criteria. And I was like, yeah, this is point that you don't need to make things so complicated that you can't follow them or understand them. How can you drill down complicated things to be what is the root cause? Like you want to find the root cause of all these metrics. I just want to find the cause. Like this is a good stock because it does all these things. Like, okay, cool. I'm going to drill that down. So it's one of those things. I to answer your question again, like I think SCHD is good. So my Roth IRA is 40% VOO. And then I have 10% in like VNQ, SCHD, SPYG, Tesla, UPRO, and QQQM. So it's like the NASDAQ. So UPRO is one that you can look into. I don't know if you've heard me talk about this before. So I've never used anything like this before. Again, not financial advice. Do what you want. Do your own research. UPRO is a 3 times leveraged S&P 500 fund. So in theory, on I think it was Tuesday of this past week, like on Valentine's Day or the day before or whatever, the market was down like 2%. UPRO was down 6%. But any day that the market goes up 1%, UPRO is up 3%. So it's literally 3 times whatever, good and bad. And I've had so many people say, oh, that's good in a bull market or whatever. Okay, what you do, there's a website I use all the time called Dividend Channel. You can do like the long-term things. You can reinvest dividends, all kinds of things. It's with 10K invested. The furthest UPRO goes back is like 2000 or 2003 or something like that. So it's like 20 plus years of history. You put it in there. That's including ups, downs, housing crash, the COVID, like all kinds of stuff. It is destroying the market. What does the S&P 500 do over long periods of time? Up and to the right, right? Like,
yeah.
Therefore, no matter what the S&P 500 does, whether it's a 10-year period, it goes up 200% up and to the right, this is going to go up 600%. And some people are like, oh yeah, you make sure you keep holding it when it goes down. I'm like, yeah, when it goes down, but like the S&P 500 doesn't go down and stay down. So when it goes down and recovers, they're like, oh, because they'll start telling me all these different metrics. The rule of 72, or make sure you know when it goes down 10%, you need to make 11% to get your money. Like I hear all that. But what I'm telling you is the S&P 500 has been down 10% before, and it's gotten back 11% before. It's not out of the realm,
Yeah, yeah,
especially with an ETF. With an individual stock, it's different. But like the S&P 500, I think they said over the course of 20 or 30 years, there's never been a stretch of whatever one of those I mentioned. There's never been a stretch where the S&P 500's at a negative return. I think it's like a 20-year period. You can do 20-year blocks starting and ending wherever in 20 years. Never return negative money, ever. So it's like over the long term. And again, like I said, completely different depending on your timeline and all kinds of stuff. But if you have time, you almost can't lose. And like I said,
yeah.
it's only 10%. And the reason it's such a high percentage is I only have 7 things in my Roth. VOO, the regular VOO is 40%. And then everything else is 10. UPR is one of them. I literally bought it like December or January 3rd or 4th of this year. It's already up 19%. So I check it out. Like I said, do your own stuff with it. But like UPRO, and I think there's one, I think it's called like TQQQ or something like that, is the NASDAQ version. I haven't looked into that one enough yet.
That's a hardcore one.
Yeah, that one, because I think that's triple or maybe even quadruple leveraged, which is but like I don't think tech's ever going anywhere. Just like I don't think oil and gas is ever going anywhere. No matter how green we try to make the earth or whatever, the amount of things that you use oil and gas for outside of fueling your vehicles, you're never replacing it. It's the idea is try to preserve it and use less and use other sources because we're smart enough to develop things like that. So like I don't think they're ever going anywhere, but oil and gas had its time. But I don't know that I don't think the time on tech ever runs out. I think tech just keeps advancing.
I
So
agree.
you could argue that the NASDAQ one could be even better. I just don't know. And I just learned about it on like Thursday or Friday, so I haven't looked into it yet. But
Yeah, I agree when you talk about Nasdaq generally because you have all tech stocks there. So you are not betting in one where the industry may suffer some disruption. The technology that governs that industry may change completely, and maybe that single company fails. If you have Nasdaq, you are quite protected, which is the role of diversification. I wonder if you have a perfect number of stocks that a portfolio should have. Usually, I hear that no, you should have as much as possible, because if one company goes to zero, it's not gonna hurt you so much. At the same time, I hear that people say, yeah, but if you have a lot of companies, it's hard to keep up with all the news regarding those companies and follow them in details. For me, I don't agree with neither. I think if we have metrics like yours that you mentioned before, or mine, where we are basically what's left is just the creme de la creme, just the very good companies, I think the risk of going to zero is very, very minimum. And if it's about to go to zero, you're gonna know before. It's not from one day to the other, I think, for very good companies.
mm-hmm.
And when people say that you cannot keep up with a huge number of companies, I also disagree, because I think you don't need to. You can use, there's a lot of phenomenal financial services on the internet, like Simply Safe Dividends or Seeking Alpha or whatever, and they do the job for you, and they just give you the final scores for each company. And I think also Morningstar does it very well. For me, the problem with excessively diversification is the opposite. When people say, oh, what if you have something that goes to zero? Then you are protected, right? But for me, the problem is the opposite. If one of your companies doubles value or triples, you're not gonna perceive so much if you have 200 companies in your portfolio. So in this moment, I'm aiming for 20 companies. And as I mentioned, I already have 30% in ETF, so I think I'm quite diversified. So in this moment, I'm aiming for something between 20 and 30 companies in my portfolio. What do you think about it?
Yeah, I've looked that up a bunch of times. So I think the consensus is the perfect number of companies is 20 to 25. That's just what people found. I guess it's enough companies to be diversified to risk, but also be concentrated enough to receive the benefits like you were talking about. When I first started, I had 36 individual companies and 3 ETFs. And I exactly what you were talking about. I was spread so, and now mind you, I first started. I think at the end of my first year, I finished with 12,000 in my portfolio, like $12,000, and it was one of those things where when you have $12,000 split between 39 holdings, you don't have a lot in anything unless you're like extremely overweight in something and underweight in another. But it's one of so I don't know. For me, I have 11. I have 9 active holdings. I have 11 total holdings. And then, like I said, Roth is all ETFs and Tesla. I know a lot of people have like a certain percentage they don't like each of their stocks to be. Like they don't want, an individual stock to be above 5% or 2% or whatever. I am on the side, and I've said this before, I'm on the side where I think, like not even now, like not for you and me now, but for later, the diversification, I think should switch from how much of each company you own to diversifying your income. To me, I wouldn't want more than a certain percentage of my money coming from a certain stock. Because like what happens is, like you said, about like selling or cutting, or maybe it doesn't raise as much as you were projecting it to raise or whatever. I wouldn't want 36% of my money coming from realty income. I would want to make sure, okay, I don't have any of my companies paying me more than 3% of my income. That way, if something were to happen, an unforeseen cut, or they change management and they have a completely different style or whatever, you don't have to worry about like 3% of your income. Like that's just like, hey, we can't eat out every week. We can only eat out every 2 weeks or whatever. Like it's one of those kind of things. And like, that's the bigger thing. But like I said, for me and you, where we are in our investing journey, and a lot of people that are around our age, I just want to have a few companies. I want to build up a big position in those companies. Ideally, and you might get into this later, this might not be for you, I don't know. I do want to start playing with like the options income.
I was going to ask you about it.
I want to be so conservative with it.
I love this one here.
Yeah, like I know generally how options work, and I have a bunch of people that I know that do options. Like Jeremy, he was my second interview. He does them. I'll definitely reach out to him. What I want to do is I want to do the thing where it's like, hey, you're gonna get very little premium for this because it's not likely or super likely or whatever. I just want to do that to make a little bit extra, and exactly what I was talking about with the ETFs. I want to slowly learn them because at the end of the day, I don't want to lose any of my holdings at all. So maybe I'll do that with like a dormant position where when I get enough shares to have a dormant position to do options on, I might be a little bit more risky because I'm like, hey, this has been dormant. And if it's been dormant for consecutive years, 2, 3, like I said, this is my first year doing it, so I have to mold this strategy. But if a company that I hold has been dormant for maybe back to back or 3 consecutive years, maybe I'm like, okay, maybe I start writing my options a little bit more aggressive, and I would be okay with getting the premium and losing my shares and getting more money. So say like NextEra Energy is one of mine. I'm still buying it because it's below my cost basis.
My largest position, my largest single position.
Yeah. And like people give me all kinds of crap for that. Didn't they just announce like a 10% or 11% raise on Friday or something like that?
10% raise, and they also
forecasted it for until 26, right?
Until 26.
Yeah. Yeah. So like that's exactly what I want to hear. We're going to do 10% for the next 3 years. So I'm cool with that. And it's one of those things where like it's one of my negative positions, but I'm still buying it. Despite it being negative and having a really bad year, it still outperforms over the last 10. So it's one of those things, but maybe I'm like, okay, NextEra Energy or APD or something like that. I'm not as highly convicted, 4 or 5 years from now. I do have 100 shares. I'm going to write some more aggressive options on these. And if I lose them, I'm okay. I'm going to take that money and start a new position. But yeah, it's one of those things. I don't have 100 shares of anything yet, except for can you write options on ETFs?
You can. I think you can.
Okay, yeah. So like I have 100 shares of some stuff in my Roth IRA. Like that's my bigger account.
Yes, you can. You can. There are lots of. I'm reminding now of some YouTube channels. You can right on ETFs. Yeah,
Yeah.
actually, it's the safest strategy because,
Can
as
you
you
do
mentioned,
it on
ETFs.
ETFs in a Roth? Like,
I
is
don't
it
know.
different by account, or like you can do it in any account?
I don't know.
Okay, yeah, I'll have to look into that because, like I said, I wouldn't mind learning it a little bit, just for like, even, I quite literally don't care if I make $1 a month in options income. To me, that's what, because it's the same exact way. People, that's the problem with convincing people or telling people about investing, is it's not the get rich quick. Which I feel like what you were talking about, like investing makes you a better person. I think dividend investing makes you an even better person because you do have to understand and appreciate delayed gratification, especially if you do it right and you're not chasing yields. Because at the end of the day, you're putting in months and years and decades of consistent dedication and discipline in order to get something later down the line. There's a funny thing I saw on Facebook like years ago where it was a dad talking to his son, and he told his son, like, hey, you can have one candy bar right now, or if you wait 10 minutes, you can have two candy bars. And the kid, he really convinced the kid. He's like, hey, wait, that's delayed gratification. But then the dad ate both candy bars and he said, oh, that was inflation. Like, it's not worth anything anymore. But it was just funny to hear about that. Like so many people, like that's one of the things I definitely want to teach my son. It's just like the value of delayed gratification. Like, you don't need to get everything right now. And oftentimes, if you don't get it right now, what you get later is worth 10 times more.
Man, I loved what you said about income diversification. That's what I've been studying the most in the last months, is trying to find new instruments, new techniques to diversify my income. I think selling options goes hand in hand with dividend growth investing and even value investing. Do you remember the example of a company going very near to the target price but
Mhm.
never touching it? You can sell cash secured puts on that stock at your target price. So you are receiving premium to wait for that company to reach your target price. Of course, there is one risk, which is it may even go lower, and you are obliged to pay your
So,
target price
so
that
if
you
a
agreed
company's at
before.
$100, you want it at 75, you sell a cash secured put to get the 75, but then if it goes to 60, you're still buying it at 75.
Yes,
Yeah.
that's how it works in theory. But since we are talking about good companies, it's very hard for them to move down a lot. So before you suffer this loss of buying a little bit more, which is already your target price, already has a margin of safety. You have already sold so many options before you collected so many premium that this difference it's still a profit for you. For me, to sell cash secured puts is the way, goes hand in hand with dividend growth investing. Then the next step is to sell covered calls, but you have the risk of losing your shares. So I still don't know exactly how to apply covered calls in my strategy in a way that the risk of losing shares is very minimum.
Well, what I've heard on that is that you want to set a price that you'd be willing to lose your shares for. So for us, for Next Era Energy, I think it's trading around like, I don't know, 55, 58. It seems to be around there right now. So if you did a covered call on Next Era Energy and you said if it got to $90, that's what your strike price or whatever would be for that. You'd set it for $90. If Next Era Energy went to $90, you would lose your thing. But also your cost basis is $58 or something. So if it went to $90, like, oh no, I happen to make all that money. But like on the flip side of that, the $90 strike price for Next Era Energy might only give you a little bit of premium because it's not likely to hit $90 because you have to pick like a date and time that you think it's going to hit that
I was
price.
gonna say I was gonna say the problem of getting strikes so far away, be it for the upper part or for the lower part, is liquidity. There is probably no negotiations at strike prices so far away, so it's not probably it's not even possible to make this kind of operation. But Nike, for example, now it's very close to my target price. I would love to be able to sell some cash secured puts at my target price and receive premium to wait for Nike to touch my target price. Maybe it will never touch, but I'm receiving premium either way. There's another income method that I recently learned. I'm not sure. It not in every broker. It's available. It's called shares lending.
Yeah, I've heard of
Basically,
that. I
you
have
you
never done
check a
it.
box in your broker, and you allow them to lend your shares to people who are gonna operate short positions. There is minimal risk of not getting your shares back, but only if your broker uh, 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 only if something really bad happens. I don't know exactly what are the circumstances, but it's basically impossible. I used to do it all the time, and you get a few percentage on the lending that the broker is doing with your shares. So it's free money. It's a way of beating the market actually, because you may put all your money on VOO, activate shares lending, so you're gonna have the VOO performance. You're gonna have the VOO dividends plus a little bit of interest on the lending of your shares.
Yeah, I'll have to look into that. So like, I'm assuming you still have ownership of the. So when the dividend comes in, you're still getting that. Like the
Yeah,
shares are still technically yours. It's just
yeah,
somebody's like playing with them in the background, kind of thing.
definitely,
Yeah, I'll have to look
definitely.
into that. Does Fidelity have that? Do you know?
I don't know about Fidelity. My broker doesn't have it. I'm dying for them to add it, but they don't have it yet.
Yeah, I know. I think Robinhood's. Everybody gives crap to Robinhood. Robinhood starts everything. Like it's like I'm pretty sure they like the fractional share stuff. They came in and they made that free, and everybody was like, "Hey, like you really have to start." Like now it's weird if your brokerage doesn't have fractional shares. Like that's a really
Man,
big
I envy
inconvenience.
I envy you guys so much there in the US because your brokers are so much better than the ones here in Europe.
Yeah, yeah, that's what Dave was saying before with his stuff in Australia and Thailand and stuff. He goes like he invests literally in U.S. stocks for that reason. He goes like the growth that you guys have over there versus what we have here. He was like it's day and night, big difference. So okay, so next thing I wanted to ask you is you've been invest. So you said you got your first dividend in June or July of last year. So what milestones are you tracking with your dividend income and like achievements have you achieved already? And like what role do those play in keeping you motivated?
Now, I still have to find a better way to measure my target, which is 12% dividend growth year over year, because I'm just computing the dividends that I receive. And so there's the effect of new capital infusion
Yeah.
every month. I have to find a way to measure that because I want 12% without the effect of new capital infusion.
Remind me of
That's
that
my
when we're
goal.
done with this interview. I'll show you what I have.
Oh, nice. Okay, perfect. Because I think I can do it somehow with Simply Safe Dividends, because Simply Safe Dividends gives me my dividend growth of the portfolio by the increase by the companies, and somehow I can add the effect of dividends reinvestment. So probably I think I have a way to measure that with Simply Safe Dividends. But my goal is that one. Of course, I want to see my total balance going up. There's no point in receiving increasing dividends if the total balance is going down. But I don't pay much attention to that because we just buy very high quality companies. If there's something really bad is gonna happen to them, we're gonna have signs before. Like you always have signs before a company cuts their dividend. Like 3M now, 3M has not cut its dividend yet, but if you check all the analysis on YouTube, you're gonna see that the cash flow cannot.
Well, yeah,
Uh,
their cash flow, their payout ratio is very high, and they've been in
yes,
lawsuits for like 3
yes.
years in a
You
row.
you, ha- you get so many signals before a company cuts their dividend. Like I guess MPW cut their dividend not so long ago, maybe a couple of months ago. It was so evident, and
AT&T.
that's that's what I love also about dividend growth investing. It's if you're gonna have a problem with your target, which is dividend growth, you have signals before and you can act on it.
Mhm.
What are your goals?
Yeah, one of the things I track, and this will be really cool. I mentioned this in all my monthly recaps. One of my favorite things to track now, because you were talking about the dividend snowball and like you're still new enough that you don't really see it yet. my thing that because I track so much information, I might not have like reasons for tracking it, but I have the data, if that makes sense. So much
Okay.
information tracked on my spreadsheet. One of the things I started tracking was exactly the snowball. I wanted to see, I would say, okay, how long did it take me to make my first $100 in dividends? Not from a company, just in general. Like all the companies working together make me $100. That was like 395 days to make my first $100. Then I was like, okay, from $100 to $200, how long did that
I
take?
like that.
Yeah. So you can see it on my monthly recap, like how I actually do it. But it's the easiest way. So like what was it took me 395 days to make my first $100. Now I'm to the point where it takes me about 20 to 30 days to make $100. And like you can now I can put it in like a bar chart or whatever you wanted to see, where you could see like a big bar in the beginning and now the bars are really small. So technically it'd be like an inverse
That's really
snowball.
motivating, actually.
Yeah. And so it's just really cool. And like I've even made it to where like this year at some point, I'm going to have to change it from $100 to $250. And I'm like, okay, how long did it take me to make my first $250? Because like now it's getting to the point where like like the last video I did for my my January update that I released at the beginning of February, I achieved 2 milestones in the same month. So like I hit $1,500 and $1,600 in the same month that I passed. So it was one of those things where I was like, okay, like now I'm starting to mention more than one per video. Like I can't do that. So like now I have to expand the bar. But like I said before, that's a good thing. That's a good thing that my bar, like it's just like a ruler. When you're measuring something really small, you're going to use the centimeters because you need the little things. But eventually, if I'm measuring a football field, I don't need to know how many centimeters are between something. Like, okay, how many meter sticks is this? Or how many yards? Like, that's how it's measured. It's not measured in Nobody knows how many centimeters a football field is. Nobody knows that.
I like that. I'm gonna do something similar.
Yeah,
Yeah, I
it's
like that. It's
super
very
easy to do
motivating.
too. Like you just go back in your history and like you probably have some kind of tracking where it's like, hey, this date I got this much from this company. Like that's what it is. And then like I'm also tracking like how many shares I'm getting dripped. So it's just like, okay, like so far, I don't know, I'm just making this number up, but so far Apple's paid me to buy 0.73 of a share. Like I don't have a whole share yet, but eventually that'll get to the point where every time Apple pays me, they're buying me a share, which will be a very long time. I just got paid from Apple, and Apple, I think, just paid me like 771 or something like that, which will be a very long time, but it's got a 0.5% yield. So it's going to take some time. But like Costco, when they're over $700 right now, the special dividend that they paid me was 99.11. So they bought me a good portion of a share, not a whole share, obviously, but like a good amount of a share, just like reinvested. I didn't spend that money on that. And so I don't know if you've heard of this. I was just thinking about this on Friday when I was updating my spreadsheet. There's some strategy that people use, and like I don't know if it's, data manipulation or whatever, but it sounds interesting nonetheless, where they take their dividends and subtract their dividends from their cost basis to figure out like their new cost basis, because technically their cost basis on a stock is based off of the money that they put into the stock at the price they purchased it at, how many shares versus the cost. But if their dividends are buying it, their dividends are technically lowering their cost basis because it's not money that they spent to do it. It's money that the company reinvested. So I don't know what that's called. It might be called something. I have no idea. But I've seen people do that. It's obviously not like, oh, I got $7.11 from Apple. I'm going to subtract that from my 154 cost basis or whatever to now whatever 147 or whatever. It doesn't work like that. But what you do is you subtract the dividends from the amount of total money that you put in that stock and then figure out your new cost basis, like I don't even know what you want to call that, like your real cost basis or whatever. But it's just another thing to track. I think it'd be pretty cool to do that. I've seen
Yes, I
some
think
people do it where they
I
have,
like that. It's probably a variation of yield on cost, which is dividends divided by cost basis.
yeah.
It's
But then
probably
like the cost basis would be different because it's not like cost basis is quite literally like what you've invested in that stock. So if I've and I don't know, I can probably do it pretty easy with all the data I have, but like I can see on my IBA, my taxable account, I've gotten whatever, $1,600, $1,700 in dividends. Of that, this percentage came from Apple or Costco or Inland Toolworks or whoever, Next Era Energy, whoever it's coming from. And I can see, like, one of the things I share in my videos is how much. So like say this month, Apple paid me 711 or whatever it was. I can go back and see the last payment I received from Apple was 653, I'm just making these numbers up, but 653, I can go back and see what my last payment was from Apple at this time last year. So in February last year when Apple paid me, how much did they pay me? It might have been 336. And then I can be like, okay, cool. Look, 7-Eleven, last time they paid me it was 653. The last time they paid me this time last year it was 356. And you're just like, look at that, like that, look at that. Like that's what you're looking for. And like I said, small numbers in the beginning, focus on that stuff because you're just starting. Don't worry about, Visa paying you 40 cents. Like don't focus on that. It's what did they pay you last time? How much extra did you add? How much are they just giving you? Like all kinds of stuff. There's so many things to focus on.
Yeah, it's true. I like that snowball metrics. I'm gonna start tracking that.
It's one of my
You
favorite
mentioned
things to track. I don't know where I came up with it, but I was just curious. I was like, man, look how, because I kept looking at all the payments and it was like 36 cents, 42 cents, whatever. And I was just like, it took me forever, literally over a year to make my first $100. How many people would give up in that time? Like I haven't even made $100 yet. And it's been over a year. Like that's ridiculous. But like I was excited. I remember getting my first penny. I was super excited about that first penny. I was like, I didn't do nothing for this penny. It's just like, so like I pick them up when I walk around the street and I find a penny on the road. I pick it up all the time. And like, it's just like somebody walking by and just dropping that in my pocket. I didn't even need to look for it. Somebody just dropped it in my pocket. I'm like, hey, there's a penny in my pocket.
You mentioned, I wanted to ask you, probably we're not gonna have a common answer for this. You mentioned you drip
Uh-huh.
a few of your assets. I don't like activating drip so much because I like to choose where to put the dividends that I receive. For example, Apple, if I judge it is overvalued now, I wouldn't want to use its dividends to buy Apple. I would like to use on something that I judge to be undervalued. And the same thing is why I don't like share buybacks. Usually people love share buybacks. They prefer share buybacks instead of dividends. But for me, the problem of share buybacks is the same. A company is buying their own shares, and sometimes they do it when I judge the shares to be overvalued. I would like to receive that in dividends and put my money elsewhere. What's your opinion on that?
I agree with both. I know a lot of people that do the drip off and reinvest however they feel need. My big thing is I don't like. I just want to keep it as so. One of the biggest things, and you seem to be okay with this. One of the biggest things that is an obstacle for people is the emotions of the stock market. Up 3%, down 3%. People always put too much into that. So I found dripping helps me take that out. Like it's just puts it back in there. A lot of the charts you look at are with dividends reinvested. So when you go on dividend channel and it's 10K, it's with dividends reinvested. It's not with the dividends reinvested at the right time or waiting for a perfect price or whatever. It's just, this is the price. It's done this thing. So I just take that out of it. I put money in, like I said, every day, regardless. I do agree with the share buyback thing. Some people just lump that in with it's a good idea all the time. But in theory, a lot of times what I've noticed is, and like I said, I'm not super into the weeds on this, but what I've observed is that companies are typically doing well when they issue a share buyback. Thus, their stock price is doing well. Thus, it may or may not be considered overvalued by whoever's metrics. Therefore, like you said, they're buying it at an inopportune time and spending money on their prices when they're the highest. It's never, APD's, like, you notice APD didn't do that. I don't think they did that. When they announced their like new dividend raise and they dropped
I'm not sure.
12%, I'm pretty sure there wasn't a message in there where it's like, APD dropped 12% and we're going to do a share buyback. It's always like, Meta announced a dividend. Their stock price went up 10% because they announced a dividend and we're going to do a share buyback. I'm like, well, now you're buying shares at 10% more than they just were. I'm like, that doesn't. So I think it's one of those things where it can be good. It can be bad. People just often lump it in as a good thing, just like dividends. People often lump in, it's a dividend paying stock. They're all equal. That's not true. All share buybacks aren't equal.
What I don't get is that usually people think it's a choice. Either you're gonna go with a company that pays dividends, or either with a company that has buyback programs. And there are literally, I'm not sure if hundreds, but at least dozens of companies that do both every year. It's not a choice. I don't understand why people see one thing or the other.
So your thoughts on this too? I know a lot of people that so Walmart just announced the stock split. I see so many people put so much value into a stock split that hurts my head. What are your thoughts on that?
I have an opinion on that. So in theory, it doesn't change anything, absolutely anything. But okay, now that you have fractional shares, it doesn't change anything, because one could say, yeah, you create liquidity because the share price is now is a lot lower, so more people can buy it. You create demand, the share price rise. But now with fractional shares, I really don't understand what is the
I
advantage.
think it's a marketing thing. Exactly what you're talking about. Like, oh, I can buy 3 shares of Walmart at $20. So like basically the question is, do you want $100 bill or do you want 520s? It's the same, like it's literally the same thing. But people are just like, oh, I can spend my 20s more places. Oh, I don't have to worry about breaking $100 bill or whatever. And they're just like, okay, would you rather have? I know this isn't the price of Walmart, but would you rather have 5 shares of Walmart at $20 a share, or would you rather have 1 share of Walmart at $100 a share? It's the same thing. Because literally everything in a split is divided. Everything in a when they reverse split, everything's multiplied. So it's like the yield doesn't go up when you have more shares. You don't get more dividends. Like all that stuff is all factored in. It's literally divided evenly, the whole thing. I don't know. It's
I
just one of
think
those things.
before fractional shares, there was some small advantage that
Yeah.
you would create demand because it would be more accessible.
Mm-hmm.
But now with fractional shares, it's really the same.
Yeah, if freaking Berkshire Hathaway would do a 500-to-1 stock split, like maybe some of us could buy a whole share of Berkshire Hathaway, but it's still the same thing.
Yeah.
But then what they do is like, it's all a game, because at the end of the day, 10 years from now, Walmart's going to do a stock buyback and they're going to be buying back the shares they just issued. Like instead of there being, they went from a 10 million shares outstanding to 30 million shares outstanding. Then over the next 4 years, they're going to be doing a share buyback to get down to 10 million shares outstanding. I'm like, they literally already, like, it was just there. Like, I don't know. But I remember the hype when Tesla was doing that, because Tesla was going up and up and up, and then they split, and then they went up and up and up, and then they split. And every time they split, it would go up 6-7%. And it was just like, that's when I started looking into stock splits and what are they about? And like, does it really do anything? And they were like, guys, it's the same thing. Like
There are so many things that a company can do to attract uneducated or naive investors.
Yep.
Like companies like ZIM or other yield traps, when they announce huge dividends, they are just trying to attract naive investors to create a demand for their stock and avoid further price drops. And stuff like stock splits and stuff like this, for me, is just mechanisms to attract uneducated investors.
Yeah. Yeah. I agree. And you're never going to, the sad part is you're never going to run out of that. Like there's always going to be another sucker out there to be like, oh, that's a good deal. Like I can get Walmart, I can get 10 shares. Like you got to think, that's the same reason people were into certain cryptos and stuff that they were into, is because instead of buying 1 share of VOO at $400, you can spend that same $400 and get 36,000 shares of Shibu Inu. I'm like, whether it's an elephant taking a dump or whether it's a rabbit taking a dump, it's still poop. Like it doesn't matter what size it is, it's still crap. So yeah, I don't know. It's one of those things where it's just like, and like that's another thing to really take away from this is like, just because a company's stock price is high doesn't mean it's a good company. Just because a company's stock price is low, like when I say high or low, just because a company's stock price is $1,000 versus a company's stock price is $26 doesn't mean that the low one is bad and the high one is good. There's all kinds of ways around that.
Also, if a company is at its 52-week high, it doesn't mean it is overvalued. It could be undervalued.
Mm-hmm.
If a stock is at its 52-week low, it could be overvalued yet.
Yeah. Yeah, I agree with that. People don't think about that either. Okay, so going back to what we were talking about before, where your goal is to eventually retire and live off of your dividends. The question I have, and you might not have the answer to this because you're just getting started. How will you know when enough is enough?
I think uh, it's impossible to give a number now because things will have a cost when in 30 years that are completely different than the costs now. But I think enough is enough when I'm able to completely cover my my life costs, my family life costs. I'm able to spend some in hobbies and in entertainment, and I'm able to reinvest a little bit. So when I have those three together, I think that's when enough is enough.
So that's way more of an educated response than I used to have. So the newest thing, so in my first interview, I talked to Chad, and one of the things that he talked about that's like really like I've been formulating it since I've had that conversation is he said he wants to go for 110%. And 110% can mean a lot of different things. What my 110% is going to be is I'm going to have our regular expenses, which is right now I think it's like $3,500 between the two of us and a kid. I'm going to have that. We're going to have what we want to save per month, which depending on where we're at in our life, like right now we're saving for a house, so we're putting a lot more back. And then we're going to have what we're going to invest per month. We're going to include all of that as our 100%. So whatever that number is, say it comes out to 6,000 or 7,000, we want to have 110% of that number, because what that does is that gives us a number to shoot for, and it's going to obviously change. Like as our expenses increase or decrease, like all that's going to change. But we're going to go for 110% of that number because we're going to be able to get to that number, retire off the dividends, live off of that. But the dividends are also going to allow us to still save and still invest while we're living off the dividends. So we're growing what we're already living off of.
I agree 100%. I liked you put a number to in what I said. I think that was it. I liked it a lot. I'm taking notes about it.
Yeah,
And
110% of
that's the beauty,
not only
man.
expenses, but 110% of everything that you spend. Get to that. It's a
Yes.
little bit more than you need, and you're still able to invest.
Yeah. And that's the beauty. Again, that's the beauty about dividend growth investing. Even if you wouldn't have that portion to reinvest, you would still receive more
Mm-hmm.
the next year, and the growth of your income would be higher than the growth of your expenses.
Yep. Yeah.
It just makes too much sense.
Yeah. Yeah. And I think that, so like, you know how some people get like really preachy about certain things and you get like turned off about it. You're like, whatever, that guy's weird. But like, that's the hard part about what we do when we talk about dividends to people that don't like investing, or dividends specifically to people that don't do it, is like, you need to not talk about it, because then people will just start seeing you and then they're like, wow, like what's he doing different? But the thing that stinks is it takes so long for that to happen. Like whenever I retire at 50, then everybody's gonna want to know what I was doing. I'm like, oh, well, I've been doing this for 24 years. Like it's not, it's a thing, but nobody cares. Like that's so I tell this literally in every interview. When you go on YouTube and you watch a dividend portfolio, everybody wants to know what the guy that has the $700,000-800,000 portfolio, what he's making in dividends. Oh, that's a lot of money. But then you quickly say, oh, I don't have $700,000 or $800,000. Like I don't have that. So then you go, like, nobody wants to go see the small portfolio where a guy's just starting and nobody cares about his 16 cents he just got from whoever. Nobody cares
But
about
don't
that.
you think they might think, oh, that guy is just starting. Maybe if I start right now, he can be my mirror, or
It,
look what he's doing. I can do what he's doing because I have this cash.
the logical thing would be yes. But what happens is some people, when they first start, they're not motivated by the 16 cents. Where we look at it and we realize, hey, this is 16 cents I didn't have that I didn't do anything to make. Some people are just like, I can't go anywhere and spend 16 cents to get anything. Like, it's not like, when your parents were growing up and they can go to the store and get a loaf of bread for 10 cents. It's not like that anymore. Like, you can't do anything with that. So like, that's why I did the anyone can invest. Cause like my portfolio with my emergency fund in it, it's like 67,000 or whatever, just for my taxable account. But like, that's already getting to the point where somebody that's brand new starting, they don't have $67,000. That's not real to them. Even though I'm making, it might be, I think I made 50 something dollars from AbbVie is one of the stock dividends I got on like Thursday or Friday. Like that's cool. Like that's a money you can see yourself spending. but that's already an unobtainable portfolio to a lot of people just starting. So then I made the anyone can invest portfolio that started at zero. I put $60 every other week into that, $5 into all 12 of these stocks, just let it ride. But I haven't gotten any dividends yet because it takes time to let the ex-dividend dates and stuff, all that stuff go through. And when I get my first dividend, it's going to be, 4 cents. And nobody's going to care about that. So
I wanted to ask you, you were mentioning YouTube now. I wanted to ask you, what are your research sources for ideas for new dividend growth companies? Because I try YouTube, I try podcasts, I try the Facebook group or reading on the internet, but I feel like I have reached a point where everything I go, the same companies are mentioned, the same.
it's so two things. So one, self plug is the Power 5 stocks that I put out. The idea behind that is exactly what you're talking about. It's a fresh list of stocks every week. Not all of them are going to fit into everything that you're looking at, but 2 of the categories are highest dividend growth rates and best 10-year returns. The idea behind that isn't to say, oh, Troy put out a new video, I'm going to go buy all these stocks. The idea behind that is, and you might have a certain category or categories you like from there. You're going to pull those, add them to your watch list, and then do your own due diligence from there. Like, okay, I do like this stock, but I don't like it right now. Or I do like this stock, but I need it to hit a certain price or whatever. Or I do like this stock and it's at the price, it's 5% off the price. I'm going to start putting my money into it, and I'm not going to go all in, kind of thing like that. Or maybe it's like, this stock this week wasn't for me or whatever. Like, that's fine. So that's the self plug for that. Power 5 is very good for that. That's why I made it. Other thing is, you don't have to always have a new stock to buy, especially since you're brand new. Build your positions. Like, unless you started your portfolio with 100K, you don't have a lot in any stock yet. So just build your positions. Realize that like there will come a time where you're ready to find a new stock. I don't know how to identify when that time is, to be honest. Like, I knew I was selling Nvidia. I knew I didn't want to go too low in stocks. I knew I wanted to add a new stock. I've always liked Costco. Ran my filters. Costco and one other company were there. I looked at the 2 of them side by side. I like that company better. One of the sites I use, it's called Dividend Radar. I'm not sponsored by anybody, but Dividend Radar is free. It uses the champions, challengers, and contenders list. And it's free. You literally go there every Friday and download it. That's where I get some of my information for the Power 5. And it's a giant Excel sheet with a ton of information on it. And it's got like the chowder number and all kinds of stuff on it. And you can literally filter for those.
The chowder number is the 12% that you want to have yield plus growth.
It's different, and like this is one of the reasons I don't use it is because it's different per sector. Okay, so like certain sectors, like if you have like an energy stock, this is from what I understand. If you have an energy stock, a certain chowder number is preferred. If you have like a tech stock and different chowder numbers preferred, and it's based off a couple different variables that give you a score or whatever, and like that's the number. Some people really use that, like they use that as their metric, and then some people use that in addition to their metric. Some people don't use it at all. So it's just metrics that are on there. One thing I do like is this thing doesn't talk about, it has like your trailing 12-month returns and stuff like that. I use VLOOKUPs to get information from other places, but it does have your dividend growth rates, and it has 1, 3, 5, and 10. And it has the percentages. So what I can do is say, I want a stock in the consumer discretionary sector, filter for that. Only consumer discretionary stocks. Then you can say, I want a stock that has a 15-year dividend streak, at least. Filter for 15 years and more. Now it filters it down even more. Then you can say, I want a stock that has a 1, 3, 5, and 10-year dividend growth rate above 9%. Filter for just that. Ideally, I tell the people this all the time. If you're doing filters on a big list of stocks, and by the time you're done with your filters, you still have a big list of stocks, your filters aren't tight enough. Like when I did my filters and I was looking for everything I was looking for, now mind you, this sheet has, I don't know, 700, 800 stocks on it, the CCC list. When I did my filters, I got down to 2. That's how filters should be. It should be like, okay, here's your small and reasonable list of stocks to now do additional research on. That's what I did. So like some people will do that and they're like, okay, I start with 1,000 stocks. I added all these filters in. I have 847 stocks to go. I'm like, that's too many. Like you're going to look through 847 stocks. What are you doing? You're going to be there the rest of your life. So like That's when it's like, okay, maybe my 1, 3, and 5 and 10 was 9%. If I still have 46 stocks to look through, maybe that's not high enough. Maybe I go 11%. And then it helps you narrow it down even more. Like whatever you have to do, but like that's a really good. So I think what you can look up Dividend Radar on Google and probably find it. I think the actual website's like Portfolio-Insights or something like that. But like I said, it's free. I don't have an account. I don't even sign in.
I'll
I
search
just
for it for
literally
sure.
down. I'll show it to you after the interview. But yeah, that's a really good thing. And like I said, by Power 5, it's just like the idea is not, oh, Troy recommended these, 3, 4, 5 stocks this week. I'm going to buy all of them. Some of them, like the idea is like some people like yield. Some people like dividend growth rate. Some people like dividend streaks. Some people like all of those. Some people like the percent they want a discount. That's why I gave all those 5 categories. Here's your stocks that met those. They all go X dividend next week. Look at them. If they add your filters now, here's the information I'm giving you, just some like little bullet points on each of them. Do your own filters. See if you like them. If you do like them, I always like comments on the video saying, hey, this is a stock I have a couple people that I've interviewed actually that use that series exactly how it's intended. Where they're like, hey, I found a couple stocks that you've mentioned that aren't the most popular stocks that I've ever heard of, but they all have a dividend streak of at least 5 years, so they're at least reputable. They made it through COVID by increasing their dividend, so that's a plus. And then you just go from there. So, I mean, to directly answer your question, use that and that list I was telling you about. I'll show you at the end of the video.
Thanks, man. Good ideas.
Yeah.
I love that you mentioned the shoulder rule because I love the concept behind it that the total return of a stock is its yield plus its dividend growth.
Mhm.
Because as I was mentioning before, if we check the dividend yield over time of a very good company, it's always within the same range. But how come it is always within the same range if the dividends are increasing every single year? It means that the stock price is increasing together with the dividend growth more or less at the same pace.
Mhm.
Another way to see it is, I don't know, NEE now has announced a 10% dividend increase. Its yield jumped to a very high level. Now investors are gonna buy it until and the price is gonna rise until the yield returns to its standards, let's say. And that's why the total return is the dividend yield plus the dividend growth. I love that concept. I use that on when I'm filtering my watch list. I like to search for 12% or higher for those for the shoulder rule. Um, Other metrics that you were mentioning about filters.
Mhm.
I don't have the filter about beating the S&P 500. I have the filter of dividend growth, more than 15 years of dividend growth. I have the filter of increasing price over time. So I just check the price chart over time, and it has to be increasing. I have the dividend safety filter, and it's not a filter, but I may order my list for how many years a company has been increasing their dividends, because for me this says a lot of things. Like we said before, it means that the company was able to increase dividends through very complex times like the recession or the COVID. But the higher the streak, I don't know how to say, the higher it is, the more pressure top management has to keep up with increasing dividends, because the effect of breaking the streak would be devastating to the stock price. So I love how the more you do it, the more you have to do it to. So for me, this filter already leaves out 99% of bad companies.
Yep.
There are lots of companies. There are still a big group of companies that have been doing it, and I don't like them, like Altria. I know that lots of people love Altria. The dividend yield is very high. They are not dividend kings, are they? Or just aristocrats? At least
Yeah, I
aristocrats.
think they're getting close to king if they didn't already pass it.
Yeah.
Yeah.
But I just don't think the business is lasting. I think it's not possible to last forever with that kind of business.
Yeah,
So
it's one of those things where I agree with that. Like they're going to have to do something in the market that we don't see, and that's not to say that that's impossible, but like just looking around, I remember growing up. Like I was born in the '90s, and I remember growing up late '90s, early 2000s. Like it seemed like you couldn't look at 10 people without seeing 5 of them smoke at least. And like I don't know how it is over there, but like now I can sit at a red light. I could be, the 20th car at a red light. I might see one window cracked with a cigarette out of it. And like now more people are vaping and stuff like that and whatever. But like, I just think that they have to find a way to pivot. I don't think, again, just like oil and gas, I don't think smoking's ever going to go extinct. I don't think you're ever going to find a world where 0 people smoke. I don't think that's a thing. But like if you find a world where less and less people smoke, even if they keep increasing the price of cigarettes, which is definitely going on. I've been saying that since I was a kid. If they want people to stop smoking, just keep raising the prices of cigarettes. Eventually, they'll have to stop or they will have lights. But yeah, so it's just one of those things where like, I don't know. I feel like that a lot of their profits are just based off the price or based off the fact that cigarettes are getting more and more expensive, not that people are buying more.
when I moved here to Europe, for me it was very astonishing to see the amount of people that smoke over here.
Really?
A lot of people smoke here. A lot of people. I would say 7 out of 10 teenagers smoke, at
Wow.
least here in Italy. At least that's what I see here in my bubble.
I wonder
In
if that's
Brazil,
more or less, or I wonder if they're just behind. Like, I wonder if it's like a 20-year cycle where they're just behind what the U.S. does. And like 20 years from now, you'll see what we see over here where it's just like not a lot of people smoke.
yeah, in Brazil, it's just we are following in the US. Almost no one smokes now, unless it's like old people that have been smoking their
Yeah.
whole lives. But you don't have new people starting to smoke in Brazil. And for me, it's difficult to imagine a business that sells one product that the only thing that makes it desired is addiction.
Yeah.
I don't know. For me, it's hard to see a
Yeah.
business that will last.
Yeah.
I know they've been
Those
around
are
for many years, but for me, it's hard to imagine it
the,
lasting for a long time.
those are just the stocks that are like commonly referred to as like the sin stocks. And some people just want them because they make them money. And then other people actually put like the morals behind it. And to each their own, whatever you want to do, it doesn't matter to me. But some people put like, I don't want to buy a company that's literally killing off their customers. Like that's quite, when you think about it, like that's what they're like. Smoking doesn't add years to your life. So literally the more money they make, the more people that are doing things to shorten their life, which is reducing their own customer pool. So like, it doesn't seem like a sustainable business
It's
plan.
confusing. Yeah.
Yeah. We're going to add more people so we can have less people. I'm like, that seems like a bad idea.
Yeah.
It's like an exclusive club that you don't want to join. But yeah, I don't know. I agree with that. Yeah, so Ultra is not one of my favorite, but it is one of the like more high quality, higher yielding stocks, at least as far as performance is concerned. And then one of the stocks that has the highest yield that meets my metrics is ABR. ABR has like a 13% yield, but still outperforms the market.
ABR, what
Arbor
ABR
Realty
is?
Trust.
Oh, okay.
Yeah. So it's weird because like so when I do my Power 5, the first category I look for is the highest yield. Again, I have all my metrics that I add, then it's the highest yield after that. What typically happens is people that watch my videos, they like yields that are a certain number. I don't give them those stocks that are a certain number because as soon as I add the filter to my list of did it outperform the S&P 500, the higher yielding stocks fall off because it doesn't do it. Like to me, it's almost like a sacrifice. Do you want the yield today or do you want the long-term performance? It's very hard to find a good combination of the two.
At the same time, I think it's a natural process to pass through that period where you are focusing on yield and then slowly you turn your focus to dividend growth.
So what do you,
you have to be very advanced to start directly with focusing on dividend growth.
Yeah, definitely.
I think it's a process,
Yeah. So what are your thoughts on, so I know of people that might be 40s or 50s. They are under the impression that they're at the point in their life that they need the yield. They need to focus more on that. But like, assuming you're going to invest for the rest of your life, assuming you live to 80 and you're
Yeah.
45,
Yeah,
one could
exactly.
argue that starting yield investing at 45 when you're going to live to 80 could be like you have 35 years left. Does that matter? Yeah. You have 35 years left. Investing a majority of your money into yielding stocks is a detriment. Like, what do you think?
Yeah. Yeah, I think this age it's very young. The average age of the human being keeps increasing over time. Quality of life keeps increasing over time. Medicine keeps getting more technologic with time. Starting at 45, 50 to focus on yield and not on growth, for me, it's very, very early.
Mm-hmm.
For someone that hasn't been starting dividend growth investing very early, I understand that this person at some time will have to shift their focus to yield to start living off from their dividends. But I expected this to be much more later than 45, 55 years old. Of course, we don't know the story behind each person, what are their needs, but for me, this looks very, very early. I I remember something we were mentioning. Sorry, I'm changing up about topics a little bit because I remember something. We were talking about diversification,
Mm-hmm.
and in my broker, it's called eToro. You have them also in the US, but it's not so famous in the US. And what I love about it also is that it is a social media, so you can post videos, pictures, your thoughts, and people comment and like it. And it's insanely high the amount of people that brag about the amount of dividend payments they receive, the number of payments they receive along the year. And I always try to say, man, it's some try to brag about how they receive daily dividend payments, weekly dividend payments. And my answer is always the same, man, you cannot build a quality dividend growth portfolio and get paid weekly or daily. There just aren't enough companies, good companies there that would fill your calendar in this way. So it amazes me how people think that the amount of payments they receive it's a good metric to evaluate a portfolio. What do you think about it?
Yeah, so so two things on that. One, I do think that the general way that people do that is they buy a bunch of monthly performing dividend or paying dividend stocks. And they just it's the same to me it's the same mindset as the split. Those are probably the same people that fall for the split idea where instead of like getting $100 from company A over the course of 4 payments a year, they would rather get $100 over the course of a year, but paid monthly. And I'm just like, it's the same thing. And often it's actually, would you rather get $96 or $90 over the course of the year, but we pay you monthly? Or would you rather get $100, but we pay you quarterly? Because often I'm seeing a lot of the companies that do pay more frequently happen to be less quality companies, which is what you were saying. And one of the counter, I don't want to say counter argument, but the one thing I will say is I made 2 portfolios, and then also the anyone can invest portfolio. That was one of the ideas. One, the anyone can invest portfolio was like, hey, you don't need a lot of money to start this. I'm putting $5 into every stock every other week kind of thing. The other thing is I constructed that portfolio to pay weekly, but it's made of 12 quarterly paying stocks that are all high quality. And what I actually made like there's a whole spreadsheet that would blow a lot of people's minds. Whole spreadsheet talking about like, here's these stocks that pay out in January, April, July, and October, whatever the months are. These stocks, when I did my filters, I needed those stocks. If you pay out in January and you pay out January 1st through the 7th, you need to also pay out in April 1st through the 7th, July 1st through the 7th, and October 1st through the 7th. If you pay out in any of those months on the 11th, you're disqualified. So I literally did, and I think it was 5 or 10 years worth of dividend paying history to determine the average payout date of those. And that's how I did the list. So that list does pay out. The portfolio will pay me out weekly. Technically not weekly because it's 48 of the 52 weeks. So there will be 4 weeks. But like some of them, it's like this one paid me Monday, this one paid me Friday, so I don't get paid the next week kind of thing. But it's close enough because like the 1st through the 7th always doesn't fall the first week of the month kind of thing. So yeah, that addresses what you were just talking about, is a lot of people sacrifice the frequency of their dividends for the quality of their companies. And that's one of the reasons I made that portfolio. I was like, how can I make a portfolio that doesn't sacrifice quality of the companies, but still get you? Because like at the end of the day, when you first start dividend investing, not only are you not having a lot of money, you don't know what you're doing. You start dividend investing, even if you do it the quote unquote right way and do it with lower yields, higher growth companies, you're not getting paid but quarterly. And when you get paid, it's not a lot of money. So a lot of people, that's just such a big turnoff. Not only am I not getting paid, but once every freaking 3 months, but they're going to give me 16 cents when I do get paid. Like they're like, oh, that's a scam. I don't want to do that. Like I'll never get rich that way. So they fall for that. So I was like, okay, I want to address the thing of you're still not going to make a lot of money because we're still starting with a small amount of money in high quality companies with low yields, but at least you're going to get 6 cents this week, 7 cents next week, 3 cents the following week. And it's just going to constantly keep coming in. And that's like that. It's delayed gratification with little sprinkles of instant gratification. I think that's what can actually get somebody there. So like, that's my, it's not again, like an argument, but it's like my rebuttal to it. I think you can look at the portfolio and let me know what you think, but I think it's super high quality.
How are your payments distributed of your portfolio?
My personal portfolio, mine's not good. Now that's where I think budgeting, like down the road, what we were talking about of like living off the portfolio, I think that's where it comes down. Cause for me, I get of my 11 holdings, I know it's one pays me in January, like the 14710. One pays me in January. I think I have 5 pay me in the 2, whatever it is, 2-5, whatever. And then the rest of them, however many that is, and like another 5 or 6 or whatever, pay me in March, June, September, December. So like mine's not, but like it's going to be one of those things when I get paid and I'm living off the dividends, who knows if I still have those same holdings or if I'm transitioning into higher yields with the gains and all kinds of stuff like that. But like the thing is, I will budget like that. Like I know on 3, 6, 9, and 12, I'm getting hella more money than I need. I'm going to put extra money back, or I'm going to know, hey, in January, my dividends aren't going to be that high. I need to take some of that December money and pay for my bills in January kind of thing. So
I 70% of my income, I think it comes from March, June, September, December.
That's the most popular.
And like you, at this moment of my life, I don't even pay attention when which months my companies pay a dividend. Maybe later on this could be an issue or not. But one thing that sometimes I take into account, I think it's important, is the payment frequency. And I say this because here in Europe, usually dividend growth companies or dividend companies in general, they don't pay quarterly. Usually it's annually. And there are a few companies that I like here from Europe, like Novo Nordisk, Nestle, Unilever, and so on. But for me to receive the dividends quarterly mean that I can reinvest them more frequently and maybe compound faster. What do you think about it?
I think it's plausible. I know a lot of people so there's when you were talking about the avalanche method that you talked about earlier, you said avalanche or waterfall. I don't remember.
Waterfall.
Yeah. So there's a method out there called the dividend avalanche method, which I think has no merit to it. I want to do a video on it. I just can't figure out how to do it. The dividend avalanche method is taking $10,000, however much money, doesn't matter. Taking $10,000, putting it in TSLY, a yield max fund, getting a bunch of yield, taking all of that dividend and putting it in something high quality, your Visa, your Starbucks, your Apple, Microsoft, VOOSCHD, doesn't matter. And to me, the counter argument to be, why wouldn't you just take the original investment that you put in the lower quality company? You know it's a lower quality company. Just put it in the higher quality company, get the compounding and the lower dividend, but you can just reinvest it or do whatever. So like that's the dividend avalanche method. I don't think it works. In regards to what you're talking about with getting the dividend more frequently, allowing you to compound it quicker because you're putting that money in there more frequently, I think it logically makes sense. The thing I think about is just like, I guess that like if it's dollar for dollar always going to be guaranteed the same, maybe it's probably better to get it more frequently and reinvest it, like you said. But like I said, most of the time I'm finding it's not. Like realty income. You said you own it. A lot of people I know own it. I think that their marketing is brilliant because if you actually look at the numbers behind them, it's not much better than an average company. Because what they do is they talk about they are the monthly paying dividend stock, so they market themselves as that. I was so much so that I was under the impression as of like a year ago, maybe even less than that, that because you're a REIT, you pay monthly. That's what I thought because of realty income. I thought that was a requirement. Because you're a REIT, you have to pay monthly. That's not true. But also, they pride themselves on raising their dividend quarterly. Every quarter, they raise their dividend. If you go to Seeking Alpha and you pull up their dividend history, you look at what they're raising their dividend by, it is literally fractions of a cent. Not a cent, a
Half a
fraction
cent.
of a cent. Yeah. And they're doing that literally to keep it. A counter one that you can compare to, Tootsie Roll, the little chocolate and other flavored candies. They are in the Dividend Kings list. A lot of people don't know that. Tootsie Roll, TR, is in the Dividend Kings list. They've been paying their dividend for decades and decades and decades. Tootsie Roll does exactly what realty income does. They pay a dividend. They pay theirs, I think it's quarterly, but they raise their dividend by the smallest amount that they possibly can raise it just to keep the king status for exactly what you were saying before. Because once you fall, Tootsie Roll, I don't think does anything great in the market anyway. I didn't know it was its own company. I thought they were just part of, Hershey's or whatever, but they're not. So they know that if Tootsie Roll, who already underperforms the market, lost Dividend King status, their stock would just go in the toilet.
The end.
Their stock would be Tootsie Rolls, is what their stock like. That's what it would like. It'd be one of those things. So like, it's one of those things that like really be careful with that kind of stuff. And like I don't break down, like I said, balance sheets and stuff. Like I don't do like that stuff's confusing to me. But one thing I did look is okay, yeah, they're raising it. And what not Tootsie Roll, what realty income does is they're raising their dividend at 3 to 4% a year. That's it. They're just doing it more frequently. It doesn't make it different. Whether they did one raise at the end of the year for 3 or 4%, or they're doing their little half a cent raises every quarter, it's the same thing. It doesn't matter.
Yeah. I agree. When we are talking about half a cent, less than a cent, it's impossible to perceive if you're not a millionaire or a billionaire that invests in O.
Yeah.
Personally, this year I'm very bullish on O. I think the company is very undervalued now. It's touching almost $50 now a share. I think when we started to get the first interest rates, that is probably going to be in June or July, I don't know, O will start increasing a lot.
Yeah, I think real estate in general, like that's why I own VNQ in my Roth IRA, and that's just the Vanguard real estate fund. So it owns all of them. Like that owns O, it owns freaking Vici is another one that's really big. Owns all of them.
I just as REITs, I just have O. I have AMT in my watch list because the dividend growth rate for AMT is very, very high.
Mm-hmm.
But I just have O, and I think that's enough for me for REITs, because usually the dividend growth rate for REITs, it's very slow if they are safe investments.
Mm-hmm.
Then there are others that grow quite higher and are not so safe. Do you have like sectors that you don't like at all?
I don't own any real estate other than VNQ in my Roth. It's just not tax advantaged in a brokerage account, and I also own a house. That's my real estate. So like my house has gone up in price. It doesn't pay me a dividend, but I mean whatever. And then also I do not like any stocks in communication services.
Me neither.
I think it's the worst sector out. It's awful. The capex it costs to maintain those sectors. Yeah, it's like AT&T, most popular. Verizon, second most popular. T-Mobile, which is ironic because T-Mobile never paid a dividend. They were the only one, not the only one, one of the only ones in that sector that actually outperformed the S&P 500. Now that they're paying a dividend, I'm curious to see what the next 10 years looks like for them, because I think they're going to fall into the same trap that Verizon and AT&T did.
One thing that I don't do is I don't pay attention to sector over concentration, because at a time I only have a few companies that are below my target price, so I can buy the same three companies for quite a long time. Of course, I just started last June, so I have to see how it goes.
Mhm.
But I can I can buy the same three companies for quite some time. I can have over concentration on their sectors, maybe over concentrations in their single positions, but this is something that don't bother me so much because my target price is so conservative that I'm very confident in having large positions at them in those assets, having the average cost that I had. But this is something that usually people disagree with.
No, yeah, I know a lot of people that will not only stock by stock, they want their diversification to be a certain percentage, but they also don't want their uh percentage in each sector to be over a certain amount. So they force themselves to buy certain sectors because it's quote unquote underweight. And I'm just like, at the end of the day, like, nobody said, first of all, a lot of these people also own the S&P 500. So they're already diversified with 505 different
True,
companies regardless.
true.
And nobody said you have to own every sector. Like, there are 11 sectors, but somebody could come out tomorrow and say there's 36 sectors. Are you just going to add that many more stocks now? Because like, that doesn't make any sense. So like, one of the interviews I did with Kenyon a long time ago, he is super focused into tech because he's in the industry. He knows the stuff. He does a lot of research on it. He understands it. He's overweighted into tech according to everybody else. But like, it's a sector he understands, and he might not own anything in healthcare or whatever. He doesn't understand it. He doesn't like the metrics. There might not be any stocks that fit his numbers, whatever. It's your portfolio. You know, the cliche saying, it's personal finance, it's personal kind of thing. But like, do it however you wish. There's no right or wrong answer. Just understand that there's consequences and repercussions to anything you do, whether no matter how well you think it out or how poorly you think it out. And that's why one of the first questions I lead off with is like, what's your biggest dividend mistake? And more importantly than the mistake is the lesson learned. Just because something goes to crap, don't assume it was bad luck or bad timing or my luck or what. Don't assume that. Like, what is the thing that you can learn from that? So like, for me, NVIDIA, I give this story all the time. I was up 55% on NVIDIA. I sold because it didn't meet one of my metrics. I was able, like I said, I went through the whole thing. It worked out for me. Everything's good. But had I, like, now knowing what I know, that's what I consider to be a mistake, is I sold a quality company just because it didn't meet one of my metrics. I didn't have value on my metrics as to which one's the most important. Now I do. My metric that's the most important is the outperformance of the market. Because if not, I might as well just invest in the S&P 500 and make my day a lot simpler. So like, I care the most about that. Then I don't know. To me, the dividend streak, I'd probably say the dividend growth rates are next because I want those to be high. I don't necessarily, if you are a company that has a 6-year dividend streak or a 60-year dividend streak, it means nothing different to me. As long as it wasn't 6 years followed by a cut, because it could be we didn't pay a dividend, now we started it 6 years ago and now we're good. So if it's like, hey, every 7 years we cut our dividend, like, I don't like that either. But like, if it's one of those things, so like, I'd probably say my order is outperformance, dividend growth rate, dividend streak. So like, now I have that thing. And to me, the one that is non-negotiable is the outperformance. So like, I have my patent, NVIDIA does outperform. So it doesn't meet my other two metrics, but those are less important. So it's still, so I would have kept it, is what I'm trying to say. But learning your lessons, learning from your mistakes, actually understanding the things that caused your mistake. Making your mistakes in the beginning is very important when you don't have a lot of money. I give this example all the time. If you lose 10% of $1,000, you lost $100. If you lose 10% of $1 million, you lost $100,000. It's the same 10%. But you'd rather make a 10% mistake when you have no money because it doesn't hurt as bad. I mean, it still hurts at the time. You know, I lost $100. That still sucks. But yeah, it's just one of those things. I don't know. To each their own. I don't think. Don't force yourself to own something just because somebody says you're under. Like, look at Warren Buffett. Warren Buffett has freaking 47% of his worth in Apple.
He
Like,
reduced 1%. I don't know why, but I read
hey,
it yesterday.
the people have gotten to him, man. All the stuff that he's hearing on Twitter, he just couldn't take it anymore. He had to sell a percentage. That's what it was.
Yeah, I think what you said explains everything. If you are able to explain your operations, why you have something, why you are overweight on something or not, then everything's fine. If you are able to explain everything, then because if you are able to explain everything, you are comfortable with your positions, and therefore you can sleep at night. You can withstand when the direction is not the one that you have foreseen. So everything becomes it becomes easier to hold what you have, let's say like this.
Yep. And that's why I say, like before, is like, just because I make a video on a stock or you watch somebody else's channel or read a book on a stock or what, I don't know if stocks are mentioned in books because they're books and they can be read for decades. But anyway, wherever you're reading something about a stock, a Facebook group, don't just buy it because, like, you have to do your own research, because what, speaking from experience, is what happens when you buy those. The moment they start going down, those are the first ones you want to sell, because you're just like, oh, I didn't, I don't really like this stuff. You don't know enough about whether how detailed or how not detailed you want to be about a company. You don't know enough about that company to be like, oh, if Apple goes down 5% on Tuesday, because the market's closed on Monday, if it goes down 5% on Tuesday, I'm still buying it. I give the example every interview. If you go to Walmart, you want to buy a flat screen TV, it's $400, and you're like, ah, crap, I left my wallet at home, I have to go back. If you come back to Walmart and that same TV is now on sale for $300, you're not going to be like, wait a minute, what's wrong with this TV? You're like, heck yeah, man, I'm getting it for $300. I was just going to buy it for $400. It's the same thing when I do my stocks. I have my stocks. I don't care about the price. I have 60 years to let it grow. If it's the same price now, 60 years from now, I did something wrong. So like, I don't care whether I bought it at 186 or 173. It doesn't matter to me. It's still going to have a lot of money. So, yeah, it's just one of those things, man. You just gotta, the noise is whatever. Like you said, have an idea, have an understanding. Don't be married to it. Be willing to a change. Like if I would have had the same strategy I had when I first started, I'd be screwed. But like, I've changed it. You've changed yours, and you've only been doing it for less than a year.
But usually it's so hard to discuss with people when they have a different opinion.
Mm-hmm. Yep.
It's in the Facebook group, for example, people get offended if you don't like a stock they have, or if you don't agree with a movement they did. Why that? Why do people get offended?
I don't know. It's not your, like, if I think this, like, I know a lot of people that invest in AT&T. I think AT&T sucks. It's not my money. If they put 100% of their money into AT&T and it goes to zero, I don't lose any money. Now, yeah, that stinks. Like if they would have, quote unquote, listen to me. But on the flip side, they put 100% of their money. I think AT&T sucks. AT&T triples tomorrow. Now I'm an idiot because they were right. I was right. It doesn't matter. It's not your money. Like everybody can have, this isn't just for like stocks. This is just for things in general. Everybody can have their own opinion. It doesn't matter. Like you don't need to freaking everything doesn't need to be your opinion. Your opinion's not always right. It's your opinion. And another thing is like stepping back and don't beat yourself up or crucify yourself over a decision you made based off the information you had. That's one thing I really try to stress to people is like, you can't look at what you did a year ago, 5 years ago in your dividend journey, but like, how I was such an idiot. Like, why would I do that? You literally made that decision off of educated information you had at the time. You can't say, knowing what I know now, that's clearly stupid. The cool thing you can do is you can step back and say, hey, I know enough now to say that's a bad idea. That's the exciting thing, because now you know more. Because if it's a bad idea 5 years ago and it's still a bad idea today and you're still doing it, that means you didn't grow at all to learn that that's a bad idea.
Talking about opinions, you said everyone has an opinion, but usually people explain their position with the wrong arguments. I remember once in the Facebook group, we were discussing about SCHD, and this guy was saying that, oh, that's it, I'm gonna sell it. SHD has been flat for the last 2 years or something. And then I wrote something, try to understand why it is flat, and maybe you will change your mind. And then the argumentations that the guy did to try to convince me that to sell SHD was a good idea is to mention all his other positions, how much he was up on them. And then he said, look, this other position, I sold it and then it fell. This one here, I'm up 30%. This other one, I'm up 40%. I'm here, I want to discuss the idea. I want to discuss the strategy behind it, the concepts, the technicalities. When people start to present how much they did with other investments or how much they avoided to lose, for me, it means nothing,
Mm.
because I just want to focus on the strategy, on the technicalities, on the rationales. Uh, uh, what's the way of thinking? That's what I want the discussion to be. And usually I feel that people start to push pull the discussion to these other kind of things that for me are useless. Have you ever seen this?
Yeah, I mean it's sometimes it's just I think sometimes a misunderstanding of like, because his counter argument wouldn't be wrong, but he's arguing the cost benefit, like the more or less the opportunity cost of investing into something else other than SCHD. Well,
No,
you're
actually, what he was trying to say is, look, I know what I'm doing. Look what I did
oh,
here
okay,
with
okay,
these
yeah,
other
no, no.
ones.
I was thinking he was like, to me, like an argument like that would say, hey, had I invested the same amount of money into this, it would have been like, that's a different argument. But like, and you weren't saying that that's not the case. You're not saying that SCHD is the best performing stock over the last 2 years. You were just saying, hey, consider the environment that SCHD is in and why it's down. And do you think that that environment is going to persist or change in upcoming years? And like, to me, sometimes that's just like people not understanding what your argument is. They think you're arguing something else. Because at the end of the day, like sometimes I'll get emails at work and I read them with an attitude. Like I'm sensing that the person that's sending it to me is being a jerk. And I'm just like, they could be literally the nicest person of all time. And they're just sending me a nice, happy email and I'm reading it in a bad tone because I'm in a bad mood or
True.
whatever. So I think it's the same kind of thing. Some people are just, you know, the amount of people I've tried to convince that yield max are bad ideas would blow your mind. It's my number one video on my channel, yield max. I was trying to understand them for myself. Made the video. The video has over 100 comments. Most of the comments are, I just don't get it, or you'll see, or wait till we're in a bear market. And like that one comment sticks in my head so much, to wait till we're in a bear market. One, you're waiting, missing out on money, or in that case, losing money. And two, everybody knows that bear markets are a fraction of the time of bull markets. You're going to wait for the 1% and miss out on the 99. That seems backwards to me. Why don't you plan for the bear or plan for the bull market and prepare for the bear market? Why don't you do that? Like, that's smarter to me. Why would you plan or like be excited about the bear market and then prepare for the bull market? Like, why would that? That doesn't make any sense. I think like you're doing it backwards. But at the end of the day, that's my opinion. If you want to lose your money in yield max funds, enjoy your monthly distribution of your own cash flow back to you, and we'll go about there.
And again, man, if there was, for me, dividend growth investment is the best by far strategy out there. But if it was the absolute true, we wouldn't have so many other strategies out there. There are lots of people making money with index investing, trend following,
Yep.
investing, day trading, swing trading. You can make money in a lot of ways. I just think this one is the healthiest one.
Yep. Yeah, I agree with that. It's there's no right or wrong. Well, I don't want to say there's a lot of right and a lot of wrong answers out there. It's not like, dividend growth investing is the only way. And a lot of it could just be the simple fact that like the characteristics of somebody that successfully does dividend growth investing could be more beneficial to investing in other parts of your life more than a day trader or something like that, or somebody that just does crypto. Because
That's
like
true.
that stuff's like 24/7. It's high stress. You have to watch the markets all the time. Like it's all kinds of stuff like that where we're more buy and hold, just identify a good company, buy it and keep it for a long time. So, like I said, it's to each their own. I don't say somebody's the right or wrong way. I might have my opinion and say, hey, I think yield max funds are dumb, but maybe somebody's a millionaire off of yield max funds and I'm the idiot. Who knows? But, yeah.
But what I have never seen a person that was a dividend growth investing and then changed strategies. I see the opposite all the time.
Yeah.
People that were doing other type of strategies and went to dividend growth investing, but I have never seen someone that was a dividend growth investor. For me, that says a lot.
Yeah. Yeah. It's the same thing with like, maybe because I'm in like YouTube or I'm active on a lot of the groups or whatever. I get reached out to a fairly regular amount of times on Facebook from like in Messenger from like different spammers and stuff. And it's always, and that's another reason, like maybe we talk about dividend investing, but we don't like talk about it too much kind of thing. Because the thing that I'm always pushed on is crypto and Forex. Every single, oh, what do you do? Oh, I'm a day trader for Forex or whatever. And I'm like, I've never in the history of my life been spam messaged by a dividend investor. Like, I'm never just like, oh yeah, Warren Buffett's burner account didn't just reach out to me and say, did you know how good Coca-Cola is? Like, that's never happened in the history of it. It's always like, hey, did you know that you can trade this foreign currency? Or did you know I can do this and I can get you a crypto wallet and turn your Ethereum into these coins? And I'm like, I don't know what you're talking about. Not interested. I'm like, I don't know. So it is like exactly what you said. It's always what somebody comes from and what they go to, and do they leave that thing they went to? Most of the time with dividend investing, they don't. Like I've never met anybody that did that either. I never interviewed. You're like I said, my 31st interview, I think, never interviewed anybody like, back in the 80s, I used to do dividend investing. Now I'm all into crypto. I'm like, I've never heard that. I might have people that have been like, okay, I have part of my portfolio in crypto, but they still, at the root of who they are, they're still a dividend investor.
And usually when I found people that were against it or thought that it doesn't work, is because they didn't know how it actually was.
Yep.
They gave the argumentations that I told you before that in my opinion are wrong. So in my very short experience, the times that I saw people against it is because they didn't know it.
Yep. Yeah, I agree with that. Yeah, it's they base their decision off of the information of, and that's why I said with whether it's books or whatever, you're like, you always want to get the counter to what, obviously whoever's talking to you about whatever they're talking about is for that thing. Get the counter to that and make your own opinion somewhere in the middle. Like I said, it doesn't need to be 50-50 in the middle. It could be 80% towards one side and 20% towards the other side. It doesn't have to be that. So,
and just listen, trying to learn what the others are saying. You may disagree completely about his strategy, but there's probably one small technicality over there that you can apply in your strategy.
Yep. And that's kind of one of the points of these interviews is like somebody could think both of us are idiots, but there could be one thing that we said in a 5-minute clip on this whole interview where they're like, hey, that's a good, like the snowball thing. Like you might think everything I said's an idiot. Like, oh, Troy doesn't care about stock price. He doesn't know what the heck he's talking about, but he did say that snowball thing. And I think that's pretty cool. So it could be one of those things. And like I said, it's to each their own. There's no right or wrong answer. It's an individual journey for everybody. The idea behind the books and these interviews and stuff like that is that somebody else learned that lesson. And if you can learn that lesson for free without having to learn it with spending your own money, like that's the hack. If you can, I lost, I sold Nvidia at, I don't know, $450 something. Now it's $700 something. I missed out on $300 per share for however many shares I had. You don't have to make that same mistake if you adapt like the active and dormant strategy or order your criteria that you select your stocks by, like order them in an order of importance. Like, hey, this one falls off, it's a no-go. We're getting rid of it. Like you said, cut a dividend, no-go. We're getting rid of it right away. No ifs, ands, and buts. If it underperforms the market, like maybe that's a hold. How long is it a hold for? Kind of stuff like that. So, but hey, Kyle, so last question I'm going to ask you is what tips would you give your younger self? Pretend you're 18 years old. You have all the knowledge. So you're not going back in time and be like, oh, I know what Apple's price is today. You're just 18 years old right now. You have all the knowledge you have today. What tips are you giving your younger self?
Discuss with as much people as possible. Listen, trying to learn, not trying to answer. Read as much as you can. Watch as many videos as you can. Be open to learn new strategies. And be humble. That's it.
Yeah, I like all those. Those are really good. I kind of changed that question from what it used to be to what it is now, and I think this is a better way of thinking it. Because I know a lot of people are like, oh yeah, if I could go back to 2000, I'd buy Amazon stock. I'm like, all right, well that's cheating. Like we all know it. We're not 2020 here. Like we don't have hindsight. Okay, so Kyle, tell the people where they can find you. If you have anything to plug, if there's any Facebook groups or Instagram channels or anything that you want to plug, go ahead and plug those in here.
Okay, so my Facebook and my Instagram is my name, Caio Daud, Daud is my last name. I have an Instagram page together with my wife. We try to educate people about dividend growth investing. It's called the Income Growth Office. Also through this Instagram page, We share a monthly newsletter for free with all our operations during the month, our portfolio analysis, metrics, news about about the market, uh, companies that are in our radar, and so on. And also, you can find me on eToro. Also, my account is my name, Caio Daud. Go there and give me a follow if you can.
Yeah. Hey, I appreciate you for coming on the show. I see it's nighttime at your place already. That's wild to me. So yeah, I appreciate you spending time. I hope I told you getting these interviews to last an hour was impossible. So you got to experience that. So again, it was a blast speaking with you. Check Kyle out at all his stuff. He's going to send me the links to all that. That'll be in the description down below. If you guys want to check him out and get that free newsletter, you can't go wrong with free newsletters. So Kyle, thank you. It's been a blast, and we'll talk to you next time.
Thank you so much, Troy. This has been very educative for me. I hope you were able to grab a couple of information new for you also. This was very educative to me, for real. Keep up what you are doing, man. This is a great channel. Keep up with the motivation, and let's keep educating people about dividend growth investing.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.